Hello, my name's Elliot Yu, and I want to welcome you to our second ever issue of our brand new deep dive investing service that I co-founded with my good friend and colleague Roger Conrad. And all of you who are on this beta test and watching this video should have already received Roger's presentation just last week on natural gas pipeline companies, including his recommendations of 3 different high-yield pipeline companies to have a closer look at. Tonight, I'm going to talk about another one of our favorite sectors, what we think is a very timely play right now, and is likely to be one of the best performing sectors over the next 1 to 2 years, and that's the regional banks. And the format of this presentation is going to be much like Roger's last week. First of all, I'm going to talk a little bit more about what I see the deep dive investing service being and progressing over time. Also, I want to address very briefly some of the comments and questions we've received about the deep dive investing service from you, our beta testers and our best subscribers and best customers. And you had some very useful comments, and I hope you'll continue emailing in with comments, suggestions, and questions as we move forward. So I'm going to start talking a little bit more about deep dive investing. Then I'm going to move into sort of a big picture outlook for the regional banks, why we think this is such an exciting sector, including, of course, the macroeconomic backdrop, the regulatory backdrop under the new Trump administration. Then we're going to move into some individual picks. Now, some of you who are subscribers to our Pig versus Bear service will recognize KeyCorp, which is one of my recommendations tonight. Those of you who read our Capitalist Times Premium service will recognize Comerica, another one of my picks tonight. But I'm also going to look at 3 additional banks that I think are particularly well placed to benefit from the current environment, and in particular are buys right now. And we're going to talk about what those banks are, why we like them, and also a strategy for buying them. In addition to this video presentation that you're watching right now, we also have you should have received a link to our presentation slides that you can download in PDF format, in Adobe Acrobat format. So if you have trouble seeing the slides on your screen, that was one of the big areas of feedback we did receive after the first episode or the first issue of Deep Dive Investing, was that a lot of subscribers had trouble reading the charts or seeing the detail in the charts. And I hope that we're going to improve that situation tonight. I've tried to make the slides as readable as possible, and if you have trouble reading them on your screen, be sure to download and check it out in that PDF format. In addition to all of that, I've also included an appendix, which you should have also received a link to, which is a look at about 78 banks that I took a look at in researching for this issue of Deep Dive Investing, including some key metrics, some financial metrics that we looked at in evaluating these banks. So it includes both the banks we recommend and a whole long list of other banks, large and small. And I'm going to talk a little bit more about why we think the financial metrics that are in that appendix are important. And again, that's downloadable in PDF format, so it should be relatively easy to read. First up, what is deep dive investing? And I know we talked about a little bit about this last week before Roger's very thorough deep dive into the natural gas pipeline industry. But our fundamental belief has always been, from the very beginning, when I started working with Roger, going on about 18 years ago now, and Roger, of course, been in this business even longer than I have, we believe there's great value in a thorough understanding of the fundamentals that drive the performance of industry groups and individual stocks. And we think that you can actually do better picking individual stocks and sectors than buying an exchange-traded fund or simply buying the biggest and most recognizable names. And over the years, we've prided ourselves on really digging into industry groups like energy in our Energy and Income Advisor service, and Conrad's Utility Investor, the utility sector. We dig into the individual names and look for names that are most fundamentally advantaged and pick those rather than buying a broad-based ETF, where a lot of these ETFs, most exchange-traded funds, are market capitalization weighted, which means that really when you buy the ETF, most of your money is going into the biggest, largest companies in that industry group. And oftentimes we found with exchange-traded funds, you're getting good companies, you're getting bad companies, and you're getting really ugly companies all mixed together. We believe that there's a lot of upside to picking individual names that are particularly well positioned. We already do a lot of research for the various services we manage, including Energy and Income Advisor, which I just mentioned, Capitalist Times Premium, Conrad's Utility Investor, and our trading service Pig versus Bear. And in addition to the research that we present in all those different services, we also look at other industry groups in a more deep dive way that maybe don't necessarily fit into any one of those particular publications particularly well. Deep dive investing is going to give us a chance to present that research that we already do, that Roger and I already talk about usually several times a week in conference calls that we host between the two of us, and present that to you, our best ideas and our most timely ideas. We are looking to focus in this service on the most powerful and timely investing themes across all the areas we cover and research, the trends and themes that we believe are best positioned right now to make you money. This service is not about vague analysis or just a big picture outlook. We intend to give you actionable advice, as Roger did last week with the 3 natural gas pipeline companies that he recommended, and I intend to do this week with 5 different banks that I'm going to recommend as buys right now. Also, we're not going to just give you recommendations and then walk away and never give you updates. Expect within the Deep Dive Investing service, in addition to these lengthy videos and deep dives into individual stocks and sectors, expect shorter updates. And also expect us going forward to track recommendations that we've made, including how they've returned compared to the market and just in absolute terms, and give you updated advice as to whether maybe you should sell something, it's run up too far, or the fundamentals have changed. We will be updating our advice, and we will always provide you with actionable advice in these issues. Why did we decide to launch Deep Dive Investing right now? Well, this is, I think, is a very important point. And that's that over the last several years, really going back to 8 years ago, coming out of the financial crisis and the so-called Great Recession, the stock market's kind of been like a rising tide that's lifted all boats. Of course, there's been pullbacks within the broader uptrend, but during the uptrends, especially over the last couple of years, there's been sort of a rising tide that's lifted all companies in the stock market together. And a lot of that's been based on the fact that a lot of the upside in the market has been based on monetary policy and monetary combination and things like quantitative easing. And because it's all been about the Fed and other central banks around the world pumping liquidity into the market, it's kind of pushed up the value of all assets together. And so we've seen a big shift towards passive strategies, just buying the index rather than trying to pick individual stocks and sectors and individual names that can do better than the index. We think that that's already changing, and particularly it's changed a lot since the presidential election last year. We're now seeing the Fed raising interest rates, kind of trying to drain this excess liquidity in the system. And we're seeing a shift in the primary driver of the market from liquidity and monetary accommodation to potentially actual economic growth and therefore business momentum for individual stocks and sectors. So we believe active management and stock picking are already starting to outperform passive strategies. This has been a theme we've seen on and off over the last year, and it's been getting stronger since the election, and we think it's going to continue to win out. And that's where a service like Deep Dive Investing really comes to the fore, in the sense that we're going to be looking at these sectors in great depth and picking individual names, not telling you to buy into a passive strategy. So as I said at the beginning of the presentation, today I want to talk about regional banks, and in particular, I'm going to focus today on small and mid-sized US banks. I'm not going to talk as much about the big money center banks. Obviously, many of you know that in the Capitalist Times Premium service, we do recommend Citigroup. I will mention that at the end. But today, I really want to look at the small and mid-sized banks because, frankly, as I'll explain in a moment, that's where I see some of the biggest upside and some of the best returns for actual stock picking, rather than, of course, buying an index of banks. So first, let's look at where we've been. And this is a chart of the relative strength of of a small and mid-sized U.S. bank index versus the S&P 500. This goes all the way back to 2002, and it's really easy to interpret. It's a relative strength line. When it's rising, it means that these banks, these regional banks, are beating the S&P 500, and when it's falling, it means that regional banks are underperforming the S&P 500. And what you can see here is that really from the end of 2001 all the way up through 2005, 2006, regional banks outperformed the S&P 500. As you might expect, as we entered the financial crisis in the latter half of 2007 and through 2008 and into 2009, in fact, regional banks by and large massively underperformed the S&P 500. And what's happened since the financial crisis? Well, the group's been basically flat since the S&P 500. From 2010 all the way up through November of last year, up until the presidential election, small and mid-sized banks, the regional banks and local banks and community banks in the US that are publicly traded, performed kind of flat with the S&P 500. And I'm talking about this on a total return basis, meaning I'm looking at both price appreciation of the stocks as well as returns from dividends. So you can see that for most of that period, from 2010 up through 2016, banks performed pretty much in line with the S&P 500. After the election, we really saw these banks break out, and since the election, there's been a real boom, a lot of upside in these small and mid-sized banks. Here's another way of looking at it. The orange line on this chart, and again, if you can't see these lines well, I tried to make this chart as sharp as possible. If you can't see these lines well on your screen, be sure to follow along in the PDF file, which you should have received as a download in the email announcing this issue. That orange line is a KRW Regional Banking Index, which is basically an index of 50 small and mid-sized US banks. The KRW Banking Index, which is in green on this chart, is larger banks. So that would include JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, US Bancorp, all those names that you've heard of. And of course, the blue line on this chart is the S&P 500. So what I did is the last recession in the US ended in June, at the end of June of 2009. And I looked at the performance of these different banking indices versus the S&P 500. This is just total return from all three of these indices over the time period since the last recession. What you can see is that all three of these indices are higher, but the regional banks performed basically just in line with the S&P 500, as I showed you in that last chart. The big banks in green line here, which again is your Bank of America's, JP Morgan's, etc., they massively underperformed the S&P 500 from the end of the financial crisis and recession in June 2009 up until August 31st, which is where this chart ends, of last year, right before the election. Why did the big banks underperform both the S&P 500 and the small banks over this time period? I believe a lot of it has to do with the regulations that were put in place since the financial crisis. Regulations like Dodd-Frank, which I'll be talking a lot more about in a minute, the so-called stress tests held by the Fed, which again I'll be talking about a lot more about in just a minute. A lot of those new regulations applied mainly to your large banks, banks with more than $50 billion in assets, and therefore they negatively impacted the large banks more than the small and mid-sized banks. So I'm going to talk a little bit more about that in just a minute. Now, since the presidential election last November, the banks have blown away the S&P 500. Over this time period, the S&P 500 is up about 12.5%, 13%. Your small and large banks are up in the 25 to 29% range. So they're outperforming the S&P 500 since the US presidential election by roughly 15%. So a lot of people ask, well, the banks have already run up quite a bit. They're already up 25 to 30% since the presidential election. Is there more room for them to rise? Well, we believe that there is. One of the more common measures of valuations for banks, of large banks and small banks, is what we call price to tangible book value. So tangible book value is essentially the value of a company's tangible, which means physical assets. So that would be that would be assets that are actual physical assets that can be measured and quantified. The more common intangible assets are things like goodwill. And goodwill is an accounting measure that arises when one company acquires another company. Now, if a company acquires another company and the acquisition target is trading above its book value, the difference between that company's book value and the acquisition price is placed on the acquiring company's balance sheet as an asset, and it's called goodwill. So it's not a physical asset, it's not actual cash on the balance sheet or an asset like, for example, a loan on a bank's balance sheet. It's an intangible asset. It's basically an accounting input. So when we measure valuations for banks, because a lot of them tend to be highly acquisitive, especially in the small and mid-sized space, you tend to see a lot of acquisitions. There's a lot of goodwill on their balance sheet. We exclude that from book value before calculating their valuation. So we look at price to tangible book value. First up, I'm looking at the KRW banking index, which is the large banks. And you can see that prior to the financial crisis in 2007, they typically traded as high as 3 to up to 4 times tangible book value. From the end of the financial crisis in 2009 up until late last year, up until the presidential election last year, they tended to trade more like 1 to 1.7 times tangible book value. And only just right after the presidential election and up until the present time did valuations break out, and we're actually trading a little higher than that. We're trading above that 2009 to 2016 range on valuation. But the important thing to note is, despite that spike in the banks that I showed you on the prior slide here since the election, and despite the fact that the tangible book value, the price to tangible book value, the valuation for the large banks is towards the high end of its post-crisis range, it's still down well below what it was back in that 2002 to 2007 period. In fact, I could have taken this chart all the way back to 1996, and you would have seen that the average valuation for banks over that 1996 to 2007 period was closer to that 3 times tangible book value. Now we're still less than 2. So just if the large banks got up to the kind of valuations they saw prior to the financial crisis, there's a lot of upside for the group on a valuation basis. Smaller banks are also cheap relative to where they traded pre-crisis. The KRW Regional Banking Index, which I mentioned is a lot of smaller banks, including the names I'm going to be focusing on in tonight's presentation, they have also seen somewhat of a spike in total return since the presidential election, and also the valuation is back at the high end of its 2009 to 2016 range, but it's still only about 2.3 times or so, a little under 2.3 times tangible book value, compared to 3 times to 3.25 times common back before the financial crisis. So we think there's a lot of valuation upside from the regional banks as well. Why are valuations lower today than where they were prior to the financial crisis? Well, I mean, at first glance, you might think that the answer to that's kind of obvious. Obviously, the banks face a lot more regulatory issues than they did before the financial crisis that have meant that they're not as profitable as they were prior to the financial crisis. However, there's also another very important factor, which I'm going to talk a little bit more about in a minute, which is that this lower for longer interest rate environment that we've been in since 2008, where the Fed has kept interest rates down pretty close to zero, and in fact many central banks around the world have pushed interest rates below zero, that is very toxic for banks. It is very difficult for a regional bank to earn money lending money out when interest rates are right on the floor, right near zero. And I'm going to explain in more detail why that is in just a moment. But the impact of heftier regulations since the financial crisis and this lower for longer interest rate environment has been that banks just aren't as profitable as they were prior to the crisis. And one of the more common measures of profitability in the banking industry is return on tangible equity, ROTE. The higher this number, the higher the returns to shareholders are. And as you can see for Comerica, which is one of the banks that I'll be recommending today, Comerica, prior to the financial crisis, used to generate return on tangible equity of 15 to 20% at times. Post the financial crisis, it's been more like 5 to 10% return on tangible equity. So the return on tangible equity is, let's call it about half of what it was prior to the crisis. And that's one of the reasons that the company's price to tangible book value, its valuation is much lower. Company's not as profitable. It can't support as high a valuation. Here's another look. This is another company, First Horizon National, which is a bank actually based in Memphis, Tennessee. This is one I'm going to talk about. This is not a recommendation tonight, but it is one I'm going to talk a little bit more about towards the end of the presentation. This company generated return on tangible equity from 1999 up until 2006, early 2007, in a 20 to 30% range. And since the financial crisis, since the initial recovery from the financial crisis, it's generally been around 10% or lower. So again, the return on tangible equity, the profitability has declined, and that's one of the reasons that this company trades at a much lower valuation, price to tangible book value, than it did before the financial crisis. So here are the bones of the investment case for the banks and for the regional banks in particular, we believe, over the next couple of years. First of all, as I mentioned before, this lower for longer interest rate environment has been pressuring banks' net interest margins in recent years. Now, a net interest margin is a measure basically of the amount of return a bank gets from lending money, which is the basic business for most regional, small and mid-sized banks. Of course, larger banks have all sorts of other businesses, but your community banks and your mid-sized and regional banks tend to focus a lot of their money comes from basically taking in deposits and lending that money back out to businesses and consumers, and hopefully earning a higher interest rate on their loans than they have to pay depositors in interest. And that's basically the net interest margin. It's a difference between the cost of their capital, which would mean the amount of money they have to pay depositors or whatever their source of funds is, and the amount of money they receive in interest on the money they lend out. So net interest margins have been falling over the last few years, as I'll show you in more detail in a minute, because interest rates across the board have been lower. Short-term interest rates have been pegged near zero up until December 2015, when the Fed raised interest rates by a 1/4 percentage point, and they followed up with another 1/4 percentage point increase last December, and almost certain to hike interest rates in mid-March of this year, next week. So I believe that they're going to hike interest rates next week, but still interest rates are very, very close to zero. They've only done 25 basis points, 0.25% hikes. But of course, long-term interest rates have also been depressed, partly because the Fed's quantitative easing, buying these bonds directly, has pushed down the yields on 5-year U.S. government bonds, 10-year U.S. government bonds, and even 30-year U.S. government bonds to record lows over the last couple of years. So interest rates across the board have been pushed down, and that means that the banks aren't earning much of a spread between the cost of paying depositors interest and the amount that they're able to charge on loans. In addition to that, as I also mentioned, new regulations, and in particular the so-called Dodd-Frank bill, have pushed up expenses. How much have they pushed up expenses? I was just reading a survey or a study the other day that said for the 6 largest banks in the United States, their compliance and regulatory costs, which is basically the product of all these regulations, has doubled between 2007 and 2013. So that's in dollar terms. The total expenses for compliance and regulatory issues has doubled from 2007 to 2013. And that's just the 6 largest banks. Obviously, there have also been regulatory costs for a lot of these small and mid-sized regional banks, which I'll talk about a little bit more in a minute. In addition, all banks with more than $50 billion in assets are subject to even more stringent regulations, the so-called SIFI rules, systemically important financial institutions, or SIFIs. One of the things they have to do is go through annual stress tests that are run by the Fed, which basically looks at their capital position under different types of economic and macroeconomic scenarios and evaluates how healthy the bank would be under these different scenarios, these different stress tests. And what it means is that if, the Fed can literally say to a bank, no, you can't raise your dividends. You have to pay. You can't raise your dividend because we don't like how you performed on the stress tests. They can limit banks' ability to return capital to shareholders, and of course, these increased expenses their need to hold more capital and therefore be able to lend out less money have held down return on tangible equity and kept these banks from having the kinds of valuations that they had prior to the financial crisis, as I showed you a minute ago. So new regulations have been a big headwind for the industry over the last few years, both in expense terms and their ability to return capital to shareholders through dividends and share buybacks. Here's our core view. These two headwinds, the interest rate headwind and the regulatory headwind for the banking industry, are dissipating because interest rates are now in the early stages of an upcycle, and the United States is entering an easier regulatory environment under the new Trump administration. And I'm going to talk a little bit more about that in a minute. It's very important not just to make a blanket statement that because President Trump is generally perceived as being easier on regulations, you should go out and buy the banks. I want to look tonight at the individual regulations that are most likely to change and what it means for the banks. Our view is that the profitability, the return on tangible equity for the banks, should expand over the next few years back by 2019, 2020 to the levels we saw prior to the financial crisis. So profitability is going to rise, and therefore, we believe over the next 2 to 3 years, valuations for the group can rise back to the levels we saw prior to the last financial crisis. So we think valuations are going to expand, and we think that growth is going to pick up for the banks, and therefore their book value should also expand. And we think that you're going to see more profitability, higher valuations, and of course, higher profits. Finally, we think there's a lot of room for alpha. What is alpha? Alpha is excess returns from stock picking or careful stock selection and sector selection. The truth is that there are dozens of banks, regional and local banks in the United States. I have an appendix which includes about 70 plus of these banks, which you have included that you can download in that email. There's a link to download it in the email we sent you announcing this issue of deep dive investing. I have a list of about 70 banks, including a bunch of financial metrics for all these banks. There literally are dozens of banks, or regional and local banks in the United States, and they're all focused on different regions of the United States. And we're going to talk a lot about geographic exposure, which is very important tonight. And also have different types of loan books. Some of them are more heavily into business loans, some more heavily into consumer loans or credit card loans, or home equity loans, or residential real estate type loans, or commercial real estate loans. All of these different types of loans, all of these different regions of the country, and all of these different business models that banks have mean that they face very different fundamentals. And so there's a lot of room to earn supernormal returns, to generate alpha by carefully selecting the banks you invest in. There are banks that have a lot of upside because they're going to have an outsized benefit from easing regulations. And those are some of the names we're going to talk about tonight. There's banks that are going to see a bigger lift because they're more exposed to rising interest rates. We call those asset-sensitive banks. And we're going to talk, and therefore, by looking carefully at all these banks, including these names that I have in that appendix, you are able to generate higher returns by very carefully selecting the banks that you invest in. So there's a lot of room for alpha, a lot of room for stock picking and differentiation. Let's talk about how banks make money on loans. This first chart here is the Citibank U.S. prime lending rate. The prime rate is basically the rate that banks charge to their best customers for loans. And as you can see, this is going back to 1996. The prime rate is basically a spread over short-term U.S. interest rates. So when the Fed is hiking rates, as they did from 2004 up through 2006, the prime rate is going to rise automatically every time the Fed hikes rates. So between 2004 and 2006, the Fed hiked rates from 1%, the Fed funds rate from 1% all the way up to 5.25%. And as you can see on this chart, over that same time period, the prime rate rose from about 4% all the way up to about 8.25%. Same thing happened in 1999-2000. And of course, the same thing has happened over the last couple of years. You can see towards the right-hand side of that chart, the U.S. prime rate was down around 3.3% At the end of 2015, the Fed hiked rates. It jumped up it had a big step up. And then again last December, in late 2016, we saw another step up when the Fed hiked rates again. Again, both times by about a quarter of a percent or 25 basis points. So the U.S. prime lending rate rises automatically alongside a rise in the Fed funds rate. So if you're a bank and you're lending money to people, making floating rate loans to a business, for example, and you're pricing the interest rate charged on that loan off the prime rate, you immediately benefit from interest rate hikes. So the second that the Fed hikes rates, it immediately drops to your bottom line because the floating rate on those loans that you gave to the businesses automatically goes up the second the Fed hikes rates by the same amount. So we saw the prime rate go from 3.25% at the end of 2015, it's jumping to 3.5% at the end of 2015 and 3.75% now. When the Fed hikes rates next week, this coming week, you're going to see it jump up again to 4%, this prime lending rate. And that means that all those banks that have loans to businesses usually at prime or a spread over prime, in other words, they charge the prime rate plus 50 basis points, those floating rate loans, the amount of interest they receive is going to automatically go up immediately. This is most commonly, not always, and there's certainly exceptions to this and additions to this, but one of the most common types of loan to be a floating rate loan is a commercial and industrial loan, or a C&I loan. And in fact, that's why in the appendix to this presentation that you should have a copy of, the last column I list for every bank in that table the percentage of their total loans that are commercial and industrial loans. We think this is something very important to keep an eye on because banks with a high percentage of commercial and industrial loans are going to tend to see more direct benefit from Fed rate hikes, because the second the Fed hikes rates, the interest rate charge on all those floating rate loans is going to immediately go up. And I'm going to talk about why that's important a little bit more in a minute. In contrast, if you're a bank that, say, loans money on a fixed rate mortgage, 30-year mortgage, the interest rate you receive on that loan is fixed, and it doesn't change with the Fed funds rate or the prime rate. It's simply fixed over time. So you only benefit from higher interest rates when that person decides to pay off the mortgage, move to another house, and take out a new loan at a higher interest rate. So it's very important to look at the asset sensitivity of banks. What percentage of their loans are floating rate loans, or loans that are going to benefit, are indexed to things like prime, or the other key rate is LIBOR, the London Interbank Offered Rate. Banks with a higher percentage of these floating rate loans indexed to things like prime and LIBOR, they're going to benefit most as the Fed hikes rates because they're going to earn more interest on their loans. Now, of course, there's the other side of this equation, which is where do banks get the money that they lend? And for most regional and local banks, it's mainly deposits. So the idea is that they attract deposits from people like you and me. They pay us a small interest rate on those deposits, and then they lend that money out to businesses and consumers at a higher interest rate. So they're earning that spread, that net interest margin, the margin between the interest they pay on deposits and the interest they charge on loans. And this is the Bankrate.com U.S. Credit Union, which is a pretty decent corollary to what we're talking about, interest rate that they pay on checking accounts. And believe it or not, back in 1999-2000, in a checking account, you were often earning 1.75% interest on deposits. So you put money in the bank, you earned 1.5% on those deposits. For many years recently, it's been pretty close to zero. Really, since the financial crisis, it's been pretty close to zero. Right now, it's at 0.09%. So as you can imagine, the banks are borrowing money, or basically taking in deposits and paying interest rates of 0.09%. And if we flip back to the prior slide, lending that money out on loans that are indexed to that prime lending rate at 3.75%, or some spread over 3.75%. So you pay 0.09%, you lend out at 3.75%, and you make money. That's the basics of how banks make money on basic loans, which is, again, the key source of profits for these regional small and mid-sized banks. Now, here's the key, of course. The big benefit for banks comes from those banks that have a lot of these floating rate loans that will automatically reset to higher interest rates as the Fed hikes rates. Now, this is a chart. It's based on what's called the Fed Fund Futures Market, which is basically a futures market that allows participants to bet on the Fed rate hike cycle. So in other words, to bet on whether the Fed's going to hike rates at their next meeting or the meeting in May or June. And what I did, and you can use the prices in the Fed Funds Futures Market to back out an implied probability. The market derived, this is based on market prices, it's not my guess or my estimation. It's simply derived off the price of these Fed Fund futures. You're able to back out an implied probability of the Fed hiking rates once, twice, or 3 times in 2017 or any other time period you want to look at. And prior to the US presidential election in November of 2016, you can see that the Fed Funds futures market was only pricing in a roughly 5% or less probability that the Fed would hike 3 or more times this year, 3 or more times. Immediately after the presidential election, that probability jumped up to 20%, or 1 in 5. Then by right at the end of 2016 and early 2017, it jumped up to about 40%. And very recently, due to some very strong economic data, and also probably even more importantly, some very hawkish comments coming out of various Fed members, indicating they're almost certain to hike interest rates at their March 15th meeting and are looking to probably hike at least 3 times this year. The probability of 3 or more interest rate hikes in 2017 has jumped all the way to 60%. I believe, and we believe, the Fed will hike at least 3 times and probably more in 2017. Assuming the economic data holds up, which we think it broadly will, the Fed is looking to push up interest rates, to start to normalize interest rates. As this has been a very unusual cycle, interest rates have been near zero for many, many, many years, and the Fed is trying to push up interest rates to what's considered a more normal level, and we think that they will hike 3 or more times. This rising probability goes directly to the bottom line for the banks. Remember, every time the Fed hikes interest rates, those LIBOR and the prime rate that I showed you a couple slides ago automatically goes up. These banks start earning more money on their loans. It drops directly to the bottom line for the small, mid-sized regional banks. So more rate hikes. It's one of the only sectors that this is true for, by the way. The more the Fed hikes interest rates, the faster they hike interest rates, the better it is for the banks because they're able to charge more on their loans, and it'll expand net interest margins. The general effect of this is that prior to the presidential election, most banks were actually guiding that their net interest margins would continue to contract 2 or 3 basis points every quarter going forward. Now, most of the regional banks and small and mid-sized banks that I looked at are starting to forecast 2 or 3 basis points per quarter or higher growth in their net interest margins. So their profitability was expected to decline, and now it's expected to expand because the Fed is expected to be more aggressive hiking interest rates because U.S. economic growth is expected to accelerate and U.S. inflationary pressures are beginning to accelerate, wage pressures are starting to percolate, etc. So we think that there's a high probability the Fed will hike 3 or more times in 2017, drops right to the bottom line for the banks. This is the chart of the net interest margin for 3 banks. KeyCorp, which is one of the banks I'll recommend. It's also a bank that we recommend in our pig versus bear trading service. Comerica, and that's in red, the red line on this chart. Comerica, symbol CMA. This is the gold line on this chart. This is the net interest margin for them. That's another bank I'll be recommending tonight. That we currently recommend in CT Premium. And I also threw in that First Horizon National, which is that Memphis-based bank. Not a recommendation at this time, but one I'm going to talk a little bit more about. This is their net interest margin. In other words, this is basically the difference between the amount that they pay depositors and the amount that they earn on their loans. And you can see that really since the late 1990s, it's been trending lower, but it really accelerated to the downside following the financial crisis starting in 2007. And it's really been drifting lower ever since 2012 because interest rates have been pegged to the floor. Banks haven't been able to charge more on their loans because interest rates have been near zero. Now, there is another side of this equation. As I said, banks' net interest, and again, on that prior slide, just as I said, you have these net interest margins are already beginning to tick higher in the most recent quarter and are expected to continue to tick higher as interest rates go up. Of course, there's another side to this equation, and that is what banks charge or have to pay to attract depositors. So in other words, if you're a person like you or me or a business and you're looking to put money into a checking account, theoretically, you might look for a bank that offers you the highest interest rate, and therefore when interest rates rise, depositors may start to look for the bank or call up their bank and ask to get more interest, and banks are going to have to raise the rate of interest that they pay on checking accounts to keep or grow their deposit base. In periods of fast rising interest rates, such as between 2004 and 2006, there can be a lot of competition between banks to attract deposits. So that competition can be in the form of offering higher interest rate accounts, savings accounts, or CDs, certificates of deposit, or just higher rates on a checking account. It could be offering other types of items like toasters were the old favorite, I believe. But the cost of attracting deposit goes up when interest rates rise, typically. And in some fast rising interest rate periods, banks can compete with each other very heavily for deposits, and that can raise their costs a lot because they have to pay more in interest to attract those deposits. We call this the deposit beta, beta as in BETA. And what that means is that let's say that the Fed funds rate goes up by 1% over a 1-year period, which I think is going to be about right this year. So the Fed funds rate goes up by 1%. The prime lending rate that I showed you a minute ago, that also goes up by 1%. LIBOR also goes up by about 1%. However, with the Fed funds rate at, let's just say, 1.5% a year from now, let's just say, your depositors are probably going to want to be paid more than 0.09 for their checking deposits, as I showed you a couple slides ago. But how much will it go up? Now, the Fed funds rate went up by 1%. The prime lending rate, which is basically the rate you're charging on a lot of these commercial and industrial loans, went up by 1%. How much will the interest rate you got to pay on your depositors, how much will that go up? If it goes up by 25 basis points, so 0.25%, that would be a 25% beta. So in other words, the rate that you pay on deposits goes up 25% of the pace of the Fed funds rate. If it goes up by 0.5%, that would be a 50% beta. So the lower the deposit beta, the better it is for the banks. Because if the Fed funds rate goes up by 1%, but you have to pay your depositors a full 1% more, then your net interest margins won't expand, because your additional interest payments that you receive will be offset by the additional money you have to pay to attract deposits. We think that the deposit beta in this cycle will be the lowest or among the lowest in modern financial history. Now, why do we think that? The reason is because the U.S. right now is completely awash in deposits. Now, as I mentioned to you a minute ago, between 2004 and 2006, interest rates rose, the Fed funds rate rose from 1% to 5.25%, so it rose by 425 basis points. There was a lot of competition between banks for deposits. They were forced to really raise their interest rates a lot to attract depositors away from other banks to back up as capital their loans. And over the long term, this is actually a chart that comes from data produced by the Federal Reserve, and they release this on a periodic basis. And I took this all the way back to 1973, which is as far back as it goes. And what it shows is the total deposits and the total loans and leases made by U.S. commercial banks. So this is basically all commercial banks in the United States. And the orange line is the total amount of money that they hold on deposit from their depositors, and that blue line on the chart is the total amount of money that they've loaned out either as a loan or a lease, like you might get a lease to lease. And you can see how these two lines tend to trend together over time. In other words, when there's more deposits and there's more demand for loans, those two tend to trend together. Obviously, banks have to have deposits to back up loans. So you'd expect that when loans are rising, deposits are also rising, vice versa. But here's what's really important. If you think about it, if the total amount of deposits in the US banking system is only slightly above the total amount of loans and leases in the US banking system, or in fact, at times, there's actually less deposits than there are outstanding loans and leases, then competition for those deposits is going to be high between banks. In other words, if there's only a few $billions of excess deposits in the system, in other words, deposits above the total amount of loans and leases in the banking system, then banks are going to have to compete a lot with one another. Typically, competition means paying a higher interest rate to those depositors to try to attract that dwindling supply of deposits. So let's look at this same chart, and first of all, what you can see here is a definite change in trend from what happened from 1973 all the way up to 2008 and 2009, and what's happened since 2008 and 2009. And this data, as I said, it's published by the Fed, and I'm really shocked that it doesn't get more attention or interest, or that very few people even look at this data. But what you can see is that since the financial crisis, the amount of deposits in the US banking system has continued to rise. So businesses and people like you and me and consumers have continued to put money on deposit and checking accounts, savings accounts, and things of that nature. But the total amount of loans to consumers and businesses fell following the financial crisis. Obviously, again, banks were required to hold more capital to back up their loans. Obviously, they got burned with bad mortgage loans, so they slowed down lending to certain parts of the economy. The economy was not growing very rapidly, therefore, demand for loans from businesses slowed. So the total amount of loans and leases in the US economy has grown at a far more sluggish pace than the amount of deposits. So you can see on this chart, I hope you can see the definite change in character from what happened between 1973 and 2008, 2009 to what's happened from 2008, 2009 to the present. And if we look at this another way, and all this chart is it's the total amount of deposits in the US banking system minus the total amount of loans in the US banking system. And you can see that for most of the period from 1973 all the way up through 1993, it was sort of up around that $250 to $400 billion level. After that, it got very tight, and you can see why there was so much competition for deposits in that 1999 to 2001 period, and again in that 2004 period, because the total amount of excess deposits in the US banking system was relatively small. In other words, there weren't that many more deposits than there were outstanding loans. Therefore, banks had to compete with one another to attract depositors. But look at the explosion since that time. And this is the very same data that you can see on this chart. You see how those two lines diverge. On this chart, I think you even get a better idea of what's happening. There's about 2.5 trillion, with a T as you see on my slide, dollars in the United States banking system of excess deposits. So these are deposits that are in the US banking system that consumers and businesses have at regional, local banks around the US, commercial banks around the US, over and above what those banks have lent out to businesses and consumers. So the banks are sitting on $2.5 trillion of excess deposits. That's more than five times the highest level prior to the financial crisis. So $2.5 trillion of excess deposits. So think about that. If I'm a bank in the United States and there are all those excess deposits out there, and I want to increase my loan book, I probably don't have to compete with another bank to attract deposits, because there's so many excess deposits out there, there's just not a whole lot of competition to attract depositors. There's plenty of money in the US banking system. It's just hasn't been over the last few years, hasn't been being lent out. Partly because, one, the regulatory environment, and two, the fact that interest rates were so low, net interest margins are so very low, banks just couldn't really lend money particularly profitably, and demand for loans has been low. Look at all that excess money in the banking system. That gives you an idea of the potential growth if the economy were to accelerate and if demand for loans were to continue to accelerate as it has very recently. We think that there's going to be a very low deposit beta, meaning that banks will not have to raise the rate that they pay depositors at anything close to the same rate as the additional benefit they're going to get from Fed rate hikes. So the Fed's going to hike interest rates, but the banks are not going to have to pay their depositors anything close to the same amount of incremental hikes. In other words, the deposit beta, we believe in this cycle, is going to be around 25% instead of a more normal 40 to 60%. So a much lower deposit beta. Here's another way of looking at this, and again, I used Comerica in red, and this gold line is Key Corp. And this is a basic measure of the total amount of loans that these banks hold divided by the total deposits that they have. So a level of 100 means that their total amount of loans is equal to their total amount on deposit. So they have $100 billion in loans or $50 billion in loans and $50 billion in deposits. The level would be 100. Levels over 100 mean that they've lent out more money than they hold in deposits. And levels under 100 mean that they have less money out on loans than they have in deposits. They have excess deposits. And you can see that in the late 1990s, early 2000s, and again in that 2005, 2006, 2007 range, both these banks ran total loan to deposit ratios over 100%. Today, both banks are showing total loan to deposits down in the low 80s. That's about the same level as in the early 1990s. They have a lot of room to grow their loans without having to even attract additional deposits. So again, not a lot of competition for deposits, therefore a low deposit beta. So banks are going to be able to charge, the bottom line, banks are going to be able to charge more on their loans as interest rates go up, but they're not going to have to pay much more into their depositors. Their net interest margins are going to expand, and I think they're going to expand a lot further and a lot faster than the market currently believes. So let's move away from the macroeconomic environment, the outlook for interest rates, to some of the regulatory tailwinds that I think are emerging this cycle. The most important one to watch is, as I said, this systemically important financial institution rule. Any bank in the United States with more than $50 billion in assets, $50 billion in assets, is ruled to be a SIFI automatically. It's a systemically important financial institution. As a SIFI, they are exposed to increased regulation, higher capital requirements under the Dodd-Frank law, and also what's called the Comprehensive Capital Analysis and Review System, which is more commonly known as the stress test. And the stress test happens every year. It's set up and administered by the Fed, and it basically looks at quantitative and qualitative factors. And it attempts to measure how a bank's capital would look, how their capital adequacy would be under different macroeconomic scenarios. So, for example, the stress test might say, okay, if there's a financial crisis like we saw back in 2007 to 2009, would this bank and loan losses start to spike up, non-performing loans start to spike up, would this bank have enough capital to cover itself and remain solvent? And so it measures the bank's capital under all these different scenarios. There's a pass or fail. And depending upon the outcome of the CCAR, the stress tests, the Fed, the regulator, the government, can tell the banks to change their dividend payouts or their share buyback plans. So they can actually regulate directly how much the banks return to shareholders as dividends or stock buybacks. Now, this is a lot of this whole system, and there's certainly myriad other regulations, and I'm not going to get into them all today. I just want to get into the most important ones. A lot of this was set up under the Dodd-Frank bill that was passed in the wake of the financial crisis, named after Chris Dodd of Connecticut and Barney Frank. Those two sponsored this bill, and that's come to be known as the Dodd-Frank bill, set up a lot of this system involving this systemically important financial institutions and the CCARs. President Trump has said on the campaign trail and since that he doesn't like the Dodd-Frank bill, and he would like to dismantle it, repeal it, and replace it with another regulatory environment. The truth of that, although you'll hear otherwise, the truth of that is going to be very tough for it to be repealed and dismantled outright because the Republicans don't control 60 seats in the US Senate. Therefore, the Democrats can block any sort of attempt to repeal Dodd-Frank in its entirety with filibuster. So there's no way really for President Trump or the GOP majority in the House and Senate to outright repeal all of Dodd-Frank. At least it would be very tough. Some things can be done using a process called reconciliation, which basically allows certain types of bills to pass the Senate with just a simple majority. The Republicans have a 52-seat majority in the Senate. So if it's a reconciliation measure, which means it has a direct impact on the federal budget, they can pass it without 60 votes in the Senate. But it's going to be tough or near impossible to completely dismantle or repeal the Dodd-Frank bill, the Dodd-Frank law now I should say, without 60 votes in the Senate. However, certain parts of Dodd-Frank can be changed without 60 votes, either through reconciliation or other parts of it can be changed simply by executive order from the president or the president's power to appoint people to certain positions, certain key regulatory positions. The Trump administration will have the authority to nominate several key regulators, including what might be the most important of all, the top banking regulator at the Federal Reserve. This seat's currently held by Dan Tarullo. He's stepping down on April 1st, and this job is called the Fed Vice Chair for Supervision. This is the regulator who administers that CCAR test, the Comprehensive Capital Analysis and Review, the stress tests, and oversees the regulation of systemically important financial institutions. So that's a very key role. The current holder is a Federal Reserve member, Dan Tarullo. He's stepping down in April, and the Trump administration will have the ability to nominate a replacement. They're expected to nominate someone, and someone to be confirmed, that will be more friendly towards the banking industry than Dan Tarullo. Already, though, Dan Tarullo has made some changes to the systemically important financial institution and CCAR regulatory environment, which is specifically that he said that banks that have more than $50 billion in assets, therefore they're SIFIs, but less than $250 billion, so in other words, they're smaller SIFIs, they won't be in future subject to the qualitative portion of the CCAR tests, only the quantitative portion. So there has been some easing of this regulatory environment even before Trump took office. However, President Trump is expected to appoint someone to this role who is more friendly towards the industry. They can change the qualifications that go into the CCAR test. So this particular regulator has a lot of power to change the CCAR test to make it easier on the banks. So for example, banks that currently are found under CCAR not to have enough capital in a more severe macroeconomic scenario, under the revised stress test, under a new regulator, maybe they will have enough capital, allowing them to increase their dividends, share buybacks, or loan more money out. So we do think that that's a key appointment that he will be able to do, President Trump will be able to do, without involving Congress. There are a lot of opportunities for more than just that, though. First of all, one of the key issues that a lot of Republicans have had against Dodd-Frank and the whole SIFI CCAR environment, regulatory environment, is that it nets a lot of small and mid-sized banks into that SIFI designation. So for a large bank, like a JP Morgan Chase, which has total assets of $2.5 trillion almost, or Bank of America, $2.2 trillion. Those banks are large enough that obviously they're going to be a SIFI bank. They're going to be subject to some sort of stress test. But they do have more money, more scope to actually be able to afford the regulatory and compliance costs of all the enhanced regulations that apply to a SIFI. But a regional bank, a smaller regional bank that has, say, $51 or $52 billion in assets, that is barely a SIFI, if you will, those costs might be prohibitive. So what we've actually seen a lot over the last couple of years is banks not wanting to become SIFIs. Some banks like New York Community Bank Corp, which currently has assets of a little under $49 billion, what they've done is they've actually sold off loans, sold off assets to try to keep themselves under that $50 billion threshold. The other effect that it's had is that prior to the financial crisis, there was an awful lot, as I said, there's literally dozens and dozens of publicly traded regional and community banks in the US. There are also dozens and dozens of privately held community and local banks in the US. And prior to the financial crisis, there was a lot of consolidation. Big banks buying smaller banks, big banks buying other medium-sized or larger banks. You're seeing less of that, especially the large and mid-sized banks. You're seeing less consolidation, less mergers and acquisitions, because if banks merge, let's say that they both have, $40 billion in assets, they go from being not systemically important financial institutions to being classified as SIFIs, which exposes them to additional regulation. So it's slowed down merger and acquisition activity a lot in the industry, and that has impacted investors' returns. So there does seem to be a push, and what we believe will ultimately happen is that we will see that automatic SIFI designation at $50 billion in assets raised probably to $250 billion or even $500 billion. So while that's still, raising the SIFI designation to $500 billion in assets, it's not going to help JP Morgan Chase with $2.5 trillion in assets, but it is going to help a bank like one of the banks that I'm going to talk about a little later on in this presentation, a bank like a Comerica or a SVB Financial. These banks are close to being SIFIs or already SIFIs, and raising that limit from $50 billion to $250 billion will mean that they're no longer SIFIs, and therefore they have more room to grow their assets by making acquisitions. They are not subject to the stress test, which maybe gives them more room to grow their loan book more, and it also it returns the decision-making process of returning capital to shareholders, either by increasing dividends or share buybacks, from Washington to the individual banks' boards, if they're no longer designated as a SIFI. The Obama administration was pretty much unwilling to accept any rollback of Dodd-Frank, including any change to the SIFI CCAR rule. However, there were several attempts over the last couple of years, generally led by Republicans, but in some cases getting significant support from the Democrats as well, to change the SIFI CCAR designation or to roll back parts of Dodd-Frank. One of them was the Financial Regulatory Improvement Act of 2015, which was sponsored by Richard Shelby, and that would have lifted the SIFI CCAR designation from $50 billion to $500 billion. Of course, it is now considered dead, and the president had said that he would veto it anyway, even if it had passed the House of Representatives and the Senate. Obviously, different game under President Donald Trump, who's likely to sign a bill that would raise the SIFI CCAR designation from 50 to 500. Then in 2016, the Systemic Risk Designation Improvement Act actually passed the House with 20 Democratic votes, so it wasn't completely partisan. And there also is some support among Democrats in the Senate for this bill. It would have removed the automatic $50 billion SIFI qualifier and replace it with some other tests of banks that are of banks as to whether they would be qualified as SIFIs, and probably mean that some of these banks that are kind of marginal in that $50 to $250 billion range of capital, of assets rather, would no longer be considered SIFIs. As I said, under Dan Tarullo, the Fed has already proposed and indicated that banks under $250 billion starting next year would not be subject to the qualitative portion of the CCAR test. So they'll still be subject to the quantitative portion, but not the qualitative portion. It's not clear exactly how much of a difference that would make, but it'll probably lower the compliance costs, again, for these small and regional, mid-sized, small, medium-sized. And then in 2016, prior to the U.S. presidential election, Jeb Hensarling of Texas proposed what's called the Choice Act, and that would exempt banks that maintain a 10% leverage ratio from many of these Dodd-Frank requirements, and it would reduce the power of regulatory bodies set up under Dodd-Frank. One of the regulatory bodies that seems to attract the most attention from Republicans and some Democrats is the Consumer Financial Protection Bureau, the CFPB. It was actually a recess appointment by President Obama back in 2012. The current head of this bureau is the CFPB, is Richard Cordray, who has been in charge of this CFPB, which has put on literally dozens of new regulations between 2012 and the present. And a lot of Republicans, including this Choice Act, sponsored by Jeb Hensarling, would like to roll back his authority and make him more directly accountable to Congress. He has very broad powers under Dodd-Frank. Richard Cordray is a person that President Trump has indicated he would like to remove as head of the CFPB. However, his term doesn't expire until July of 2018, so a little over a year, and basically a year and a half from now, 18 months from now. His term will expire. President Trump would be expected to appoint somebody who it would be more friendly to the industry, less prone to introducing new regulations. I believe that this particular, the CFPB I read the other day, has proposed more new regulations over the last 5 years than any other regulatory body in the federal government. Now, the U.S. Appeals Court in Washington ruled that President Trump could fire Richard Cordray without cause. In other words, not because he did something wrong, just because he wants to appoint somebody new. However, another court has said that they're taking a closer look at this issue. They're going to rule in May, and it may be that they decide that the president can only remove the head of the CFPB if he does something wrong for cause. But one way or the other, President Trump is likely to nominate somebody far more friendly towards the industry in July of next year. In addition, a recent executive order that President Trump signed, basically saying no new regulations without other regulations going away, will have at least some effect on the CFPB's ability to introduce new regulations, though some of the regulations already introduced may go ahead. So there is some movement on that, but that's an example of the type of regulatory agency set up under Dodd-Frank that would have been severely curtailed or eliminated entirely under the Choice Act. Now, the Choice Act, it would be unlikely to be able to pass the Senate in its current form because of, again, it would be able to be filibustered by the Democratic minority in the Senate. However, certain portions of the Choice Act, including maybe even a rollback of the CFPB, might be able to make it through. They do have fairly broad support. One of the issues out there, and this is true, of course, in Republican and Democratic districts around the country, is that a lot of small businesses, a lot of consumers, they do want to borrow money from regional and local banks, small and mid-sized banks. In particular, small and mid-sized banks, regional banks, have historically been big lenders to small and mid-sized businesses. So not your big, IBMs of the world and Cisco's of the world, but your small businesses and your mid-sized businesses that are not publicly traded, that are more local. The regional banks have been major sources of capital for them. And there's a lot of concern all over the United States that regional banks' inability to increase their loans or unwillingness to increase their loans because of some of these regulations like SIFI that apply even to some of the smaller and mid-sized banks is hurting the local economy. So that's why you do see some Democratic votes for things like the Systemic Risk Designation Improvement Act that passed last year in the House of Representatives with 20 Democratic votes. That's why you do see some across the aisle support. What does all this mean? What's the bottom line? We do believe that one of the most likely reforms under President Trump and a GOP-led Congress is a change in the SIFI and CCAR rules. I believe the most likely move is, of course, as you can see on this slide, some Republicans want to raise that designation all the way to $500 billion. I think that the compromise may be to raise it at $250 billion. That can be sold to the to the Democrats in the Senate as helping these small and mid-sized banks and small business. And of course, it's a big improvement off $50 billion for the banks. None of the small and mid-sized banks that I'm going to talk about today would qualify under a $250 billion SIFI designation, but some do qualify under a $50 billion SIFI designation. So imagine what an immediate effect this would have on those banks. If you're a bank like Comerica, right, Comerica currently has $73 billion in assets, so it's a SIFI bank. But if we raise it to $250 billion in assets, suddenly they're no longer exposed to a lot of those regulations and they can start returning capital to shareholders. That could be a big boon. That alone could be a big boost to that bank. The other regulatory issue or government political issue, if you will, is the potential for corporate tax reform. Of all the sectors in the S&P 500, the financials pay the highest effective corporate tax rate of any group, and the regional banks have among the highest effective tax rates of any sub-industry in the U.S. The effective tax rate for the KRX, which is the KBW Regional Banking Index, is 30.8%, and for the large banks, it's a little under 30%. So they are all paying almost the full corporate tax rate. So obviously, if the government cut the corporate tax rate as part of a broader tax reform from the current rate of 35% down to 15%, that would mean an almost immediate lift in earnings for these regional and larger banks because their effective tax rates would drop a lot. Some industries in the S&P 500 don't pay anywhere close to the maximum corporate tax rate because they have, for example, overseas operations that allow them to benefit from lower tax regimes outside the U.S. The U.S. has the highest corporate tax of any of the major industrialized nations. So they're able to play that international kind of tax game. But a lot of these regional and local banks, they're pretty much U.S. only. Some have operations in places like Canada, but U.S. only, and therefore this would be a big benefit to them. They can't hide from the U.S. corporate tax, but a reduction in the corporate tax rate would immediately boost their profits, their after-tax profits. But I think what is maybe even more important than that, and this is something in preparing this research and in researching the regional banks over the last couple of months, I listened to a lot of conference calls hosted by quarterly earnings calls and presentations at various conferences around the U.S. from a lot of these smaller banks. And a lot of the smaller banks pointed out that they think an even bigger effect for them is the potential for corporate tax reform to help their customers. Right? So as I said a minute ago, small and mid-sized banks, your regional banks, have historically been big lenders to small and mid-sized U.S. businesses. And small and mid-sized U.S. businesses tend to be more U.S. focused. So in other words, they're not like an IBM or something that has a lot of overseas operations, or Apple. A lot of their business is here in the United States. Most of their business is here in the United States. They also tend to be less sophisticated when it comes to tax planning. Some small businesses don't even have an accountant, or certainly their accountants aren't. They're not looking for ways to avoid taxes or to make the company more tax efficient. So they're probably paying a higher tax rate than they even need to, corporate tax rate. So a lot of these banks, several of them mentioned it at different times over the last couple of months, that they're hearing from their customers that they're very happy about the potential for a corporate tax rate reduction because that's going to have an outsized benefit on smaller and mid-sized businesses versus large businesses, which already pay a lower effective tax rate. So these small and mid-sized corporations, a corporate tax cut would free up more profits for them, allow them to grow faster, and of course increase demand for loans. So I think that while a corporate tax reform would be very good for the banks themselves, equally important to look at the potential for it to help their customers. Who are their customers? If they have a lot of commercial and industrial loans to small and mid-sized businesses, they're going to see a benefit from lower corporate taxes, which is in turn going to benefit their lenders, the regional banks. So let's move on from the macro picture and what we see from a regulatory and from an interest rate backdrop for the banks to our actual recommendation. Our first buy recommendation is KeyCorp. The symbol there is KEY, trades on the New York Stock Exchange. This is also a recommendation in our trading service, Pig versus Bear. KeyCorp's top markets for deposits are Ohio and New York State. When I say New York State, I mean their deposits, their branches are all outside of New York City, mainly upstate New York. A lot of them were purchased when they acquired First Niagara Financial Group, FNFG, which you see a little later on the slide, which was based in Buffalo. So they have a big base of assets in Buffalo, New York. That accounts for about 60% of their deposits. But if you look at a map of where KeyCorp is based, it kind of looks like a big smile across the upper part of the United States. They're also big in Indiana, Maine, Washington, Oregon, Indiana, and even all the way up into Alaska. So that accounts for the other 40% or so of their deposits. Here's what we really like about KeyCorp. Of all the banks in my coverage universe and all the banks that I cover in the appendix, which again, you should have downloaded a copy of where we have 70 some banks that I'm looking at. They're one of the most asset sensitive banks in my coverage universe. 70% of their loans are floating rate loans indexed to either LIBOR, the prime rate, or other benchmarks like, say, a 3-month treasury bill. 36% of their loans are commercial and industrial loans to businesses. And that's one of the highest levels of any of the regional banks. So what this means is that they're going to benefit immediately from rising interest rates. When the Fed hikes rates, it's going to immediately cause all these floating rate loans that they've made to businesses to adjust higher. And it's going to affect 70% of their loans. Again, a bank that has a lot of mortgages on their books or fixed rate loans on their books, they're not going to benefit immediately from a hike in the Fed funds rate. It's going to take time. Those loans are going to have to be paid off. They're going to have to find new borrowers at higher rates. They're not automatically going to see a rise in interest payments from their customers. But KeyCorp will, because 70% of their loans are floating rate. This company has $136.5 billion in total assets, so currently it is a SIFI bank. However, if the rules were to change to $250 or $500 billion in assets to qualify, then they would no longer be designated a SIFI bank at that point in time. This is important for a couple of reasons. One is it would slow the rate of expense growth for these regulatory and compliance costs. But I think more importantly, currently their dividend payout ratio, the amount of profits that they pay out in dividends, is just 29.1% on 2017 earnings. Before the financial crisis, KeyCorp routinely paid out 40-50% of their profits as dividends. One of the reasons that they're not paying out more of their profits in dividends is because they likely, under the stress tests, wouldn't be allowed to return capital to shareholders through increased dividends or share buybacks. So they're raising their dividends relatively slowly. Currently, the stock yields 1.8%. If that CCAR designation is raised to $250 billion in assets, we think that their board would immediately again have authority to raise dividends and or share buybacks. We think they would do just that, raise their payout ratio to a more normal level of 40% or 50%, implying a lot of upside to their current yield and payout. But what we're really impressed with from an operational standpoint is this bank, KeyCorp, has already been really growing its commercial and industrial loans, which I said is one of my favorite areas because they tend to be floating rate loans. They've already been growing them quite rapidly, even before the presidential election, even before potential regulatory changes were even being entertained, or interest rates or expectations for a lot of interest rate hikes has started to percolate. They were already growing their commercial and industrial loan portfolio a lot. In 2016, their C&I loan growth was 31.7%. that was inflated by their acquisition of First Niagara Financial Group. However, it was 9.2% in 2015, and excluding the acquisition last year, it was in the double-digit range. So they're already growing their C&I loans at a double-digit pace, even before all these regulatory shifts. We think that's most likely going to accelerate now that interest rates are rising. It's more profitable for them to attract loans. One of the reasons for that, I'm going to skip a couple of bullet points here, is that the CEO, Beth Mooney, who's only been in place for a few years now, has really been focused on costs and delivering on cost reductions promised by the bank. Prior management had a nasty habit of promising cost reductions and then missing their targets for cost reductions. And they often disappointed the market as a result. But in this lower for longer interest rate environment, since the bank couldn't increase the interest rates they charge on loans because interest rates were near zero, the only way they could really kind of affect their net interest margin and their profitability, or rather their profitability, was by keeping down their operational expenses. So that's really been what the CEO, Beth Mooney, has been focused on over the last couple of years. A lot of that has been involved in investing more in customer-facing staff, so loan managers, for example, but reducing back office headcount in areas that aren't facing the customer. And by investing in that customer-facing staff, so the people who are actually going out and selling loans to businesses, trying to get existing customers to borrow money under new products, that's one of the reasons their C&I loan growth has been so solid for that bank. We also really like regionally where they are. I mean, if you think about it, Ohio and New York and upstate New York, as well as some of these other states where they have a lot of deposits and a lot of branches, are states that are pretty heavily in manufacturing and other kind of heavy industries. And manufacturing has really picked up over the last few months. We've seen the Manufacturing Purchasing Managers Index really rise. We're seeing a real pickup in this sector of the economy from the middle of last year to the present. And that's going to benefit outsized a lot of their customers and also help grow their loan book. On their last conference call, they were very upbeat on the potential for more C&I loan growth. The efficiency ratio is a measure of their operating expenses as a percentage of the total cost, and rather of their total profits. So the lower this efficiency ratio, the lower their costs, the better it is. Efficiency ratio last year was 74.8%. That was inflated by merger-related costs. However, on a cash basis, it was 63.3%. And we think that under some of the new efficiency reductions targets that the CEO, Beth Mooney, has put in place, we think they might be able to get that down into the 50s, which of course would also be a big deal for their profitability. Another good sign is that already by the end of 2016, they achieved 25% of their First Niagara Financial Group cost savings, cost accretion. In other words, the cost savings they predicted at the time they agreed to that acquisition, they've already achieved 25% of it by the end of last year, which is above plan. A lot of those cost savings won't come through until this year, but it's definitely good progress. And as I said, prior management, this company kind of still sits under a cloud because a lot of analysts remember that under prior management, they used to promise a lot of cost reductions and then never deliver. But the new CEO here has definitely made good progress towards those targeted cost reductions, and that's a very good sign for meeting their targets for this year. Here's a quick map of where they are. As I said, their core is markets like upstate New York, also Ohio, Pennsylvania, and then going to the west also Indiana, Michigan, Nebraska, and all the way up to Alaska and Washington, Oregon as well. So you can see that they're kind of a smile across the upper part of the U.S., if you will. A lot of these states are core industrial states, which are really benefiting from the uptick in manufacturing activity. As I said, the single biggest reason I have for buying this stock is it screens really well on asset sensitivity. 70% of their loans are indexed to floating interest rates. As you can see, about 41% of their loans are indexed to the 1-month LIBOR rate, 6% to the 3-month LIBOR rate, 16% prime rate, 6% to other variable rates, and only 31% are fixed rate loans, which means that they immediately benefit when the Fed hikes interest rates. This is a look at the valuation and the profitability of the bank. As you can see, the gold line here is KeyCorp's return on tangible equity. I took this back to the late 1990s. To gauge this, you want to look at the left-hand scale. So the gold line goes with the left-hand scale. You can see that back in 2003, 2004, all the way up until 2007, this KeyCorp routinely managed a return on tangible equity in that 17-18% range. More recently, it's been around 10 or a little under 10. The most recent reading is only 7.5%. Their price to tangible book value has also declined from pre-crisis levels due to their lower profitability. Back in 2004 through 2007, it was routinely, and you want to look at the red line and the right-hand scale on my chart, it was routinely up around 2.25 to 2.5 times. Now it's about 1.9 times or a little under 1.9 times. We think that return on tangible equity is going to get back up to that 15% range over the next 2 years or so due to these cost improvements and, of course, expanding net interest margins due to the rising interest rate environments and KeyCorp's extreme sensitivity to these floating rate loans, in other words, really benefiting from the Fed hiking rates. And therefore, we believe that not only will tangible book value expand as they grow their loan book, loans are an asset on a bank's balance sheet, but the multiple will also expand. So we see this stock seeing a lot of upside to valuations and growth, which should power some pretty strong returns for the stocks. This is just a chart of the stock. I've overlaid the 50, 100, and 200-day moving averages on this chart. You can see that actually this bank, unlike most other banks out there, started rising even before the presidential election. It was already up a lot in October because they reported very good earnings. After the presidential election, it's really taken off. More recently, it's pulled back a bit. We do see it as a buy under 1925, where it is right now. Our target, and this is a 12 to 24 month target, is $24 to $25 a share. We think it's a buy under 1925. As I'll mention in a little while, if we do get a broader market pullback, I'll also be telling you kind of a dream buy price where I think you should acquire a little bit around current prices and maybe keep a little capital, a little dry powder on the side to buy more if it pulls back amid a broader market correction. The danger, of course, is that you may not see much of a pullback. Historically, regional banks, when they go on a run, they really go on a run, and there's not much of an opportunity to buy dips. But that's what we see where we see wanting to buy the bank and where we see wanting to buy KeyCorp and their target there. Next up, our next recommendation, Comerica. This is a recommendation in CT Premium. So these first two buy recommendations, if you're a subscriber to Pig vs. Bear and CT Premium, you've already seen them. My next three after Comerica, though, you haven't seen before. Comerica, headquartered in Dallas, Texas, of course, Michigan. I said Texas again, which is a mistake, but California are key states for deposits. Comerica used to be based in Michigan, and they acquired a company called Sterling Bancshares some years back and moved their headquarters to Dallas. So that's why they're based in Dallas, and that's why they still have a lot of branches and business in Michigan. And again, California is another key state. They are one of the few so-called traditional business banks. Of all the banks on my list, on that appendix, you'll see that Comerica has one of the highest ratios of C&I loans of any bank. It's about 55% of their total loan book is commercial and industrial loans. And again, it's one of the highest of any U.S. bank. And I'll be talking about some of the others as well. As I said, C&I loans, typically floating rate loans, one of the best places to be in a rising interest rate cycle. So like KeyCorp, Comerica also has a very asset-sensitive book. A lot of floating rate loans, a lot of business loans, immediately sees the benefit of rising interest rates. Also like KeyCorp, it's a little smaller than KeyCorp, $73 billion in assets, but still above $50 billion. They are a SIFI bank, So therefore, a raise in that SIFI designation would help them. both in terms of return of capital, raising their dividend, and of course, in terms of lower regulatory costs. Management estimates that they only have a 25% deposit beta this cycle. In other words, they're only going to have to raise the rate they charge depositors by about 25% as fast as the rates they charge on loans. So their net interest margin should expand particularly rapidly this cycle as the Fed hikes interest rates. The 25 basis point hike Fed, to give you an idea, the 25 basis point Fed rate hike in late last year, in December of last year, they believe is going to add $70 million to their net interest income this year. So that's the amount net interest income is the money they earn on loans. Total net interest income for Comerica is $400 to $500 million per quarter. And that one rate hike of 25 basis points is going to add $70 million to 2017 net interest income. So over a 4-quarter basis. So if the Fed hikes again, as I expect, on March 15th, as I expect again by June again, and maybe 1 or 2 more times this year, 3 or 4 times this year, every single time it's going to add roughly another $70 million to their annual net interest income. So you can see that 3 or 4 rate hikes, suddenly you're looking up over 200 to 300 million in annualized additional net interest income, which is almost a full quarter, 25% boost to their net interest income. So that gives you an idea how sensitive they are to rising interest rates. Prior to the presidential election, when interest rates were still kind of stuck in this lower for longer range, as I said with KeyCorp, the only way banks could expand their profitability is to cut costs. They started a new efficiency initiative called Gear Up. A lot of it was closing down unprofitable branches, consolidating branches, headcount reductions. That has also started to bear fruit. That's already started to bear fruit in terms of lower costs. When you add lower costs to higher profits from rising interest rates, you got a real boom potential in income profitability and valuations. One reason that some investors shy away from Comerica is they assume that any bank based in Texas must have a lot of energy loans. They do have a pretty big energy loan book, or they had a pretty big energy loan book at one point, and that has been a headwind for them over the last couple of years. As you know, with oil prices falling from over $100 a barrel in 2014 to as low as 26 and change at the beginning of last year, a lot of smaller drillers and smaller oil services companies came under pressure and had trouble paying their bills. Some of them even defaulted on their loans or went bankrupt. So that kind of soured the credit quality of their energy loan book. In addition, they're one of the banks that extends lines of credit to energy producers, and they've been pulling back on those lines of credit as energy prices came down, because it was assumed that the companies borrowing money couldn't afford to borrow as much money. They couldn't have as high a revolving line of credit because their proved reserves were worth less. So that's been a shrinking area for them over the last couple of years. But more recently, with the price of oil up until just last week being above $50 a barrel for some time since the OPEC meeting in late November, we're seeing a surge in drilling activity, particularly in parts of Texas, like the Permian Basin of West Texas. That credit quality and also the growth potential of their energy loan book has improved a lot, and we think it could actually expand this year. However, during this down phase, energy loans have fallen to only being 5% of their total loan book. So they really aren't as exposed as many investors think, and certainly not a reason to avoid the stock. This is a satellite image actually overlaid over where their bank branches are located. You can see again, Michigan, Texas, California, and a little bit in the Sunshine State of Florida are some of their key locations for having deposits. Here's a similar chart to what I showed you for KeyCorp. Their price to tangible book value, 1.76 times. Back, prior to the financial crisis, routinely over 2 times, 2.25 times, and back in the early 2000s, even higher than that. Their return on tangible equity also way down for what it was pre-crisis. We see a similar thing happening with Comerica as with KeyCorp. Rising interest rates, greater efficiency, An easier regulatory environment when they lose that SIFI designation should boost the return on tangible equity back up to that 15% range within 1 to 2 years, push valuations back up over 2 times tangible book value. Their tangible book value is going to grow anyway, recipe for an improving stock price. Comerica, here's the same chart I showed you for KeyCorp. We have it as a buy under 75. Our target on this stock is $90 to $100 a share. So that's our buy recommendation for Comerica. Let's move on to buy number 3. And now we're getting into the next 3 banks, as you'll see. Each of them has kind of an unusual or a sort of catalyst. I was looking, the first 2 banks I recommended are solid business banks, a lot of asset sensitivity. The next 3, I was looking for identifiable catalysts that I think make them particularly timely buy recommendations. The first in that group would be the SVB Financial Group. The symbol is SIVB. SVB stands for Silicon Valley Bank, even though they renamed themselves SVB instead of Silicon Valley Bank. It is headquartered in Santa Clara, California, right in the heart of that area of Northern California. It's focused exclusively on the Northern California market. And in fact, they focus historically and pretty much exclusively on technology companies, life sciences companies, biotechs, and the private equity and venture capital industries. All right? So they're very much focused on the kind of industries that inhabit the Silicon Valley area of Northern California. Obviously a very fast-growing part of the country. 88% of SVB's loans are floating rate loans tied to benchmarks like LIBOR and the prime rate. If not the highest of any bank in my coverage universe, certainly one of the top few, even higher than KeyCorp and Comerica. They will immediately benefit from a rise in interest rates. It'll immediately drop to their bottom line. On the deposit side of the equation, about 50% of their deposits are business checking accounts from tech companies and technology companies, life sciences companies, those types of businesses. Management said, and maybe they're putting it kind of delicately, I suppose, they're not particularly sensitive to the rates that are paid on their deposits. These companies don't tend to shop around for higher interest rates. These little startup type tech companies, many of which SVB serves, pre-public companies, not the big Cisco's of the world, but sort of pre-public tech companies, they tend to not have particularly sophisticated accounting departments and finance departments, so they tend to be very sticky. So when they have deposited at SVB, they're unlikely to switch to another bank. So that means that I think their deposit beta is going to be very low. As interest rates rise, they'll probably push up the rates they pay depositors a little bit, but since they don't have to really compete for deposits, it's certainly not going to be anything close to the pace at which their rates they charge on loans is going to rise. Here's another thing. Their effective tax rate last year was 39.1%, which is federal and state and local taxes, their total effective tax rate. Which means that corporate tax reform that would lower the federal income tax rate, that's one of the highest effective rates of any bank in my coverage universe, any of the banks in the appendix that's attached to this presentation. And therefore, they stand to benefit an outsized amount from corporate tax reform. Another thing that they indicated on one of their conference calls is that they do have quite a few customers who these tech companies, life science companies, who do a lot of business overseas and have profits that they're holding overseas that would, if they were repatriated to the United States, would expose them to a tax hit. But the Trump administration has proposed some sort of a special rate that would allow companies to bring back profits overseas at a lower tax rate. So that would probably be very beneficial to their customers as well. They also indicated a lot of their customers do have relatively high effective tax rates. Therefore, they'll also benefit their customers, not just them, but their customers will benefit from a lower corporate tax rate. Their total assets are $44.7 billion, so it's a little smaller bank than either KeyCorp or Comerica. But notice it's very close to $50 billion. It's only $5 billion shy of SIFI designation. So, especially prior to the election, this bank was preparing to become a SIFI designated bank. They were preparing probably next year, to be subject to the stress tests and additional capital requirements. So they already meet internally a lot of the requirements of a SIFI bank. If that SIFI designation were raised, though, they could probably ease off those regulatory expenses quite a bit. And it would be less likely to inhibit their growth from, say, in other words, a bank like SVB, if they find an acquisition target that's, say, a $20 billion asset bank, that would immediately make them SIFI designated. They may have waited and not wanted to make that acquisition. If they raise that CCAR limit, SIFI limit, they may be more willing to participate in M&A. In 2016, over the full year basis, their loan growth was 24% annualized. So very rapid loan growth. One of their fastest growing types of loan is what's called a capital call loan. Now, I mentioned a little while ago that one of their biggest industry verticals are venture capital and private equity companies. And mostly those companies are organized as partnerships, where there's a general partner, which is the management group, the actual private equity firm, and then limited partners, which are investors that place money in the fund. So as part of investing in a private equity fund or a venture capital fund, the general partner can issue what's called a capital call to the limited partners. In other words, tell them that they have to send in additional money to meet the return terms of their investment, additional money or money when the private equity fund wants to make an acquisition. But those limited partners have a grace period, time before they have to send in that cash. And so what happens is the general partner goes to SVB Bank and says, we need a line of credit collateralized by our ability to go out and ask our limited partners for more money. So it's a loan collateralized by the private equity firm's ability to ask their limited partners for more capital at will. Traditionally, these are very low risk loans because the limited partners are pretty well capitalized individuals and institutions. And therefore, this is a very reliable source of collateral. And it's growing very rapidly in that part of California. As you might imagine, that is one of the epicenters of the private equity and venture capital industries in the United States. So that's an area of their loan book that's growing very rapidly. And if they back off the SIFI designation, they may be able to grow it even more rapidly. Another area of their business, and this is maybe what distinguishes SVB from the vast majority of banks out there, other than their extreme asset sensitivity. They also have their own kind of private equity, private capital group called SVB Capital, which invests investor funds into privately held company, lends to privately held companies, and often gets compensated in the form of warrants or shares in those companies when they go public. The benefit of that, and I'm going to talk a little bit more about that in a minute, so before I get on the next slide, is that the problem last year was with the stock market being kind of flat for most of the year, up until right before and right after the presidential election. It wasn't a great market for companies to go public. So a lot of these private companies that SVB Capital had invested in were staying private and weren't going public. And typically SVP does best when these companies go public, see a huge pop in their first few days share price, and therefore SVB Capital's warrants and shares are worth a lot more. They're able to sell it and earn a windfall profit. With the IPO and exit market so weak for most of last year, that was not a very good source of capital for SVB Financial. Towards the end of last year, as the equity market started to take off, the IPO and exit markets, private equity exit markets, also began to take off. And therefore, this business started doing better. They're expecting a big uptick this year. Snapchat, which recently went public, a big IPO, for example, they do have some stake in that. A number of other IPOs on the calendar for this year of the types of companies they serve. So SVB Capital should also do a lot better this year. Here's a quick look at their loan portfolio. They have about $20 billion in gross loans. As you can see, most of them are to the private equity venture capital business, various technology businesses. You can kind of see Some of them are early stage, and they've got also private equity-backed technology firms. And they even have 4% of their loans to the premium wine industry, also based in Northern California. Their investment portfolio on the left-hand side of this chart, their total investment portfolio was 47% of their total assets. So you can see here that they had in 2016 that blue bar, and I'm looking at the left-hand bar chart. That blue bar was their net loans. And then you can see that they had these held-to-maturity securities and these available for sale securities. Those are all related to SVB Capital. These are stakes in companies, various types of warrants that they hold in companies that they invested in an early stage. That makes up 47% of their total assets. So their loans are a little over half, basically, and a lot of the rest is SVB Capital. So again, it's very important that SVB Capital is healthier this year because the stock market's doing better, the IPO market is opening up, a lot of these tech companies are coming public, and that gives them a lot of windfalls as these warrants and shares make good. So you can kind of see on the left-hand side, that's their asset side. On the right-hand side, they have an awful lot of non-interest-bearing deposits. Again, as I said, their customers tend to be a little less sophisticated, a little less willing to shop around for better interest rates on their deposits. So we think they're going to have a very low deposit beta as a result of all those non-interest-bearing deposits. Here's the SVB Capital area, and you can see that early last year, particularly, it really dried up. That purple bar in particular is the money they make off warrants. Warrants are kind of like options on a stock, and they really only pay off once that company comes public or exits the private market. And so you can see that in the first 2 quarters of last year, because the IPO market dried up, they didn't make much money, only $7 million in the first quarter and $5 million in the second quarter from these warrants. In the second half of the year, though, in particular in the third quarter, they had this $22 million windfall, a lot of it coming from this Acacia Communications IPO. So again, capital markets getting better, the venture capital and private equity markets getting better means a lot for their SVB Capital section of the company. This is our third buy recommendation. We want to. It's a little expensive, we think, right now, trading at 193. We would wait for a dip under 190. Our target on this stock is $250 a share. Buy number 4, Webster Financial. Symbol there is WBS. Webster Financial, you may never have heard of it. It's headquartered in Connecticut, which accounts for about 93% of their deposits, and the rest of their deposits are in neighboring states like Massachusetts, Rhode Island, and New York. Their loan book is almost 70% floating rate and about 59% commercial and industrial in total. So a high degree of asset sensitivity there, much like all the other banks I've mentioned. Over the past couple of years, management has really invested a lot in their commercial bank, basically lending to businesses. And that's really been paying off with 13.4% year-over-year increase in loans. Their smaller business banking also up nicely. Personal banking, which is an area they've been pulling away from, is only up 2.7 year-over-year. But again, we think that the better opportunities are in that business and commercial banking, so bigger companies and slightly smaller companies. That's where you get a lot of the floating rate loans, and frankly, that's where we think there's going to be a lot of growth as the economy picks up. But the big investment story for Webster Financial isn't their asset sensitivity particularly. It isn't their solid investment in commercial banks in this part of the country, and we are moving to a completely different part of the country now with this recommendation. The big investment story here is HSA Bank, which is the largest provider of health savings accounts in the U.S. with a roughly 15% market share. Health savings accounts are a pretty fragmented industry, but HSA is by far the largest player in the business, as I'll explain in a minute. And I'm going to tell you more about HSAs and why this is an interesting play as well in just a minute. Webster Financial does offer health savings accounts in all 50 states, both to employers and direct to employees, but it mainly focuses on mid to large companies and employers, not individuals so much. So, but again, though it's headquartered in Connecticut, seems like a smallish local bank, it is actually nationwide when it comes to this HSA Bank. Now, HSA accounts account for $5.2 billion worth of its deposits, which is 57% of total deposits. And the cost of these deposits, the rate that they pay these depositors on an annualized basis, is only 0.21%. So it's a very low cost source of deposits for Webster Financial. And I think this HSA Bank is the key reason to invest in this name. So let's take a look at what is a health savings account. Well, a health savings account is an account that was created by a law in the United States, a federal law in 2003. And basically it's a way for you to save money tax-free, potentially invest some of this money into stocks or bonds or mutual funds, and allow it to grow tax-free, provided you use the proceeds in this fund for healthcare related purposes. And I won't go into all the specifics of what constitutes a healthcare expense, but the idea typically is that a person with an HSA will have a high deductible insurance policy. So this is an insurance policy, a health insurance policy, where say it has a deductible of $5,000 or $7,500, where it pays pretty much nothing up until a $5,000 or $7,500 annual expense. Then it pays most or all of the expenses beyond that. So a high deductible health insurance plan is coupled with a health savings account. So you would probably pay a premium every month, or your employer would pay part or all of the premium every month for the high deductible plan. And then also a percentage of your paycheck, your biweekly or monthly paycheck, whatever, would be invested tax-free into this health savings accounts. Now, some of you may have worked at a company, I certainly did many years ago, that had like a flex spending plan where you could put money into this account tax-free and use it for health expenses, but then it would disappear at the end of the year. So you had to spend it out. I guess these still exist. You had to spend it out by the end of the year or else you'd lose the money. But HSAs aren't like that. You can continue to invest in them up until you're 65 years old. And then you can still have money in an HSA when you're 65 years old. You just can't contribute more to it under current law. So it's basically a way of saving money tax-free, growing that money and using it to pay for your healthcare expenses to cover your deductible from that high deductible insurance policy, for example. It has proven to be pretty popular since it was formed in 2003. And this bar chart is actually a source from a company called Devenir, which is one of the larger companies that analyzes this industry and consults on this industry. And the orange part of each of these bars is money that's deposited in HSAs, and the blue part is money that's invested in HSAs. So it's in a health savings account and invested in mutual funds or other types of investments. The HSA deposits are just in a checking account. Often these HSAs have a debit card attached to it. So you could have just a normal Visa or MasterCard type of debit card. And when you go to the doctor, you can use the debit card to pay for the expenses, or you go buy contact lenses or a new pair of glasses, or go to the dentist. You can use that card to pay for those expenses directly. So you can see it's really grown here. By this year, it's estimated that about 36 or 38, end of last year rather, 36 or 38 billion dollars total in health savings accounts and assets. And that's going to grow to almost $55 billion, around $55 billion by 2018. So very rapid growth in health savings accounts. But I think what's particularly interesting is the potential for it to get even bigger. Not only is it expected to get bigger anyway, but we think that any healthcare reform coming out of the Trump administration is going to rely heavily on health savings accounts. This is something that President Trump has talked about. A lot of his advisors have talked about. The idea that the replacement for the Affordable Care Act, or Obamacare, would involve heavier reliance on health savings accounts and high deductible insurance policies. So in other words, individuals would purchase a low-cost, high deductible plan and then also contribute money on a tax-free basis to this health savings account to cover that deductible should they need to incur health-related expenses. A change in regulations like that could very quickly result in an expansion of this industry way beyond what's anticipated, which is already pretty nice. Here's some growth drivers for this HSA bank within Webster. The HSA business, HSA Bank, last year contributed about 26% of their non-interest income. So non-interest income is just income that is not interest, that's not earned for, it's profits that aren't earned from lending. So in this case, HSA, they charge certain fees for administering these accounts, for administering the investment accounts attached to health savings accounts. And those fees, those service fees, are a source of profits for the HSA Bank and for Webster that doesn't involve lending. So that's one area that they could grow. Not many years ago, 3 years ago, it was only about 18 or 20% of their non-interest income. So it is growing very rapidly as a source of non-interest income for them. As I said earlier, HSA is a low-cost source of deposits. Deposits into HSA accounts tend to be very sticky. They do not have to pay a high rate of interest on those deposits. It's a very low-cost form of deposit that they can use to back up those growing commercial and business loans I showed you on the prior slide. There's a pure play company out there. The symbol is HQY. It's called Health Equity. And they are involved in basically the same business, administering these HSA accounts. They have a return on tangible, so it's a pure play. It's not a bank mixed with an HSA bank. It's just a smaller HSA-focused player. They have a return on tangible equity of 16.2%, while Webster's overall return on tangible equity is 11.3%. So I already think that their ROTE, their return on tangible equity, is going to expand because of the same drivers we've been talking about throughout this presentation: rising interest rates, cutting expenses, growing loan book. But if you consider that HSA Bank has a return on tangible equity for Health Equity of 16.2%, and it's growing as part of Webster's overall business, the growth in the HSA Bank should pull up Webster's overall ROTE as well. So we think that this is actually very accretive to overall Webster. And because HSAs are a higher return, more profitable business right now than basic banking, typically, right, that HSA business would deserve a higher multiple to earnings, book value, sales, whatever you want to measure, than straight up bank. And as I'll show you in a minute, Health Equity certainly trades at a much higher valuation than Webster, and we think that that gives upside for Webster's valuation. So let's talk about some growth in the HSA industry as a whole. In the United States, there are 170 or 175 roughly million people, that should say million, not 170 or 175 people, million people are privately insured in the US. However, there are only roughly, as of the end of last year, about 20 million health savings accounts, HSAs. So you can see that there's a lot of upside. You have 170 to 175 million people with private insurance policies, but only 20 million of them have these health savings accounts. Already growing very rapidly, but still a lot of upside to market penetration there. By the end of this decade, within 3 years, it's estimated that 88% of employers in the United States will offer HSAs. So most employers are going to offer it, but the number of employers, the percentage of employers offering it is growing very rapidly. We think you're going to continue to see more people opening up HSA accounts. It may not go up to 175 million, but it could easily go up to 50, 60, 70 million and still be a relatively low penetration of the overall private insurance market. There is a lot of upside, as I mentioned, from reform. Currently, there are about 12.7 million patients in the US insured through the Affordable Care Act's public marketplaces, the Obamacare exchanges, right? 12.7 million people. Under, Donald Trump and the Republicans have said that they're interested in repealing and replacing the Affordable Care Act, Obamacare. It's unclear whether they can literally repeal and replace it, but certainly there's going to be a lot of changes to it. One change that's being bandied about is maybe covering more people that are currently in the public marketplace, that $12.7 million pie, with high deductible plans plus some form of health savings account. So there's a potential for some of that 12.7 million to enter the HSA marketplace. Right now, you can't spend money in your HSA for medical expenses related to your dependents, your children, etc. However, there's been some talk about changing that to allow individuals to use money in their HSAs. So if you're a parent or anybody who's a dependent, in the government definition of that, you could use money in your HSA to pay their medical expenses tax-free. So that's a pretty obvious reform that there is broad support for. So that would open up potentially more people, make the HSA a more attractive format, a more attractive vehicle. There's also the potential to make more plans HSA eligible. So not all in other words, you can't just go out and get any insurance policy and attach an HSA to it. It has to be a high deductible plan, meet other requirements. There is the thought that maybe they'll make more private insurance plans eligible to have an HSA attached to them. So maybe private insurance plans that have a much lower deductible, more like a traditional insurance plan, could have a health savings account attached to them. There's also the idea that they should allow people over the age of 65, so retired people, for example, to continue to contribute to their health savings account on a tax-free basis, because as you get over more people are working past the age of 65 and therefore would have money to contribute to the health savings account, and they may need that money when they get older and their medical expenses go up. That could be a huge market for HSAs. I read recently some of the studies show as much as 2 or 3 million of the current HSA accounts are people over 65, so there could be room for upside to the assets from that. There's also 65 million people in America covered under Medicaid. Medicaid reform could involve some form of an HSA. There have been proposals to that effect. And there are 56 million people covered by Medicare. Medicare could also include an option of a private HSA type of account. So there's all kinds of reforms that are being bandied about, and growth is, even without that, growth of HSAs is already very rapid, and any of these reforms, you can see how they could very quickly add to the number of HSA accounts in the US. Webster is through their HSA bank, is the largest HSA company in America. And that gives them a lot of entrenched advantages. One thing is that how they became the largest HSA was they actually bought JP Morgan Chase, which is the largest bank in America with $2.5 trillion in assets. They actually bought their HSA bank from them. So that's how they became the largest. Another advantage they have is they already have relationships with many different insurers, most of the big insurers in the United States, and a lot of the big employers and mid-sized employers in the US, and that gives them a leg up on selling these accounts to more individuals and more employers. Basically, they already have the connections in this business. As I said, it's relatively new. HSAs are relatively new. They were created by Congress in 2003. As I showed you a minute ago, they've been growing very rapidly. But in the initial stages, it was kind of a land grab. A lot of companies were out there trying to grab a share of this business. Now the big winners are those larger players, those 5 largest players who are tending to buy up accounts from the smaller players and become even more dominant. They're the ones with all the connections in the industry. One of the big knocks on Webster that you hear, and one of the reasons some people have avoided the stock is, and I'm looking here at a straight up price to earnings ratio based on current year earnings estimates. And the top pane of this chart is Webster, which is currently trading at 22.5 times earnings. If we scroll down to, on the very bottom pane is the KRX index, which is the KBW Regional Banking Index. It only trades at 18 times earnings, forward earnings. So in other words, Webster is trading at a huge valuation premium to the overall KBW banking index on a price to earnings or even a price to book basis. So a lot of people say, well, I don't want to buy Webster because it's much more expensive than the industry as a whole. But here's what they're not fully discounting, which is that an increasingly large portion of Webster's profits and growth potential is from their HSA business. And the HSA business typically carries a much higher valuation multiple than the traditional banking business. So if we look at health equity, which I mentioned is that middle pane there, symbol there is HQY, which is a pure play HSA business, that trades at 65 times 2017 earnings. So if you look at the HSA business, HSA Bank within Webster, that probably deserves a much higher multiple than the rest of the business, and that accounts for all of Webster's valuation premium, and we believe it's more than merited. In fact, we think that the market is not fully recognizing the value of this asset within Webster. And on kind of a sum of the parts basis, Webster deserves a lot higher valuation than an average regional bank and has a lot better growth prospects. So our fourth buy in this presentation is Webster Financial, symbol WBS. We have it as a buy under 55. Our target on this stock, and again, this is a 12 to 24 month target, 1 to 2 years, $70 to $75 a share. Our fifth buy in this presentation, the final buy recommendation I have for you, is Bank United. So you kind of notice this is based in Florida, where it counts for about 81% of their deposits. The rest are in the state of New York. I'm moving around the country geographically as well. We started out in Ohio and upstate New York with KeyCorp. We went to Texas with Comerica. We spent some time in California at SVB Bank. We bounced back to Connecticut, and now we're down in the Sunshine State here in Florida. And there is a reason for that other than just regional diversification. It's that all these different regional markets, the regional banking business is somewhat of a regional business, and these different regions of the country have different fundamentals. One of them is obviously growth. So a company like SVB Bank has high growth potential because of all the activity going on in the technology and life sciences businesses. But the other one is competition for deposits. Different parts of the country have more competition or less competition for deposits, and therefore less exposure to or more exposure to deposit betas. So one of the reasons we like to pick banks from different parts of the country and pick specific parts of the country to invest in and not others is because the parts we're picking have either stronger growth rates, lower competition for deposits, more solid business growth environment, or some combination thereof. In this case, this is a Florida-based bank. Symbol is BKU. $27.9 billion in assets, so it's well under the SIFI designation, but a change in that rule could certainly allow them to make acquisitions or grow more aggressively. 29% of their loans are commercial and industrial, but 17% are residential mortgage loans, and 48% are commercial real estate loans. So I told you earlier on, I tend to prefer banks that have asset sensitivity and exposure to floating rates. And that means a high percentage of commercial and industrial loans. And, Bank United doesn't really fit that bill. Residential mortgage loans, not really the best because they tend to be fixed rate, or at least they don't have immediate exposure to rises in LIBOR or the prime rate. Therefore, they don't see that immediate boost to their interest rates that they're charging on their loans from rising interest rate environment. And then the commercial real estate loan, we have disliked generally for other reasons. The main one being a lot of regulatory scrutiny on commercial real estate lending. If you spend a lot of time in Florida or live in Florida, you might even recognize this bank. They have branches on both coasts of Florida, from Miami and north on the East Coast, of course Tampa on the West Coast, and all around. They were a pretty big bank in Florida prior to the financial crisis that did a lot of residential loans, mortgage loans, and got into a lot of trouble. In fact, They failed. They were seized by the government in May of 2009, and later on they were acquired by a private equity consortium led by a very well-regarded management team who used to be managers of North Fork Bank, which is a well-run bank in the U.S. And they acquired the failed Bank United from the Federal Deposit Insurance Corporation, the FDIC, and completely transformed the loan portfolio away from these consumer and residential mortgage loans that got them into so much trouble. But kind of because of that, and they've done a lot to cut expenses and grow the deposit base, and it's certainly no longer an unhealthy bank. Again, a lot of times, some of the healthiest banks are banks that were restructured through the FDIC process and then bought out and assumed by a new, more talented management team, led by Canis in this case, who again was a manager at North Fork Bank. The stock is cheap, way cheaper than your average regional bank, which trades at 2.3 times tangible book value. Bank United trades at 1.73 times tangible book value, amid two things. One, probably a little legacy concern around the fact that they were once a failed bank. And secondly, this huge commercial real estate portfolio that makes up 40% of their loans. And I'm going to tell you in a little while, why we think that's a receding risk. The other problem that this bank has had last year is that they saw a slowdown in their loan growth. And part of that was due to the fact that they pulled back from making commercial real estate loans due to some of the regulatory concerns, which again, I'm going to get to in just a minute. But on their most recent conference call, management sounded very upbeat about $3 billion in total loan growth for 2017 and growing their deposit base by even more than that. They're very much focused on growing their deposits by about $4 billion in 2017. They just hired a team from one of the larger banks, JP Morgan again, who are known for being able to attract deposits and do a lot of marketing around deposits. So they're investing quite a bit to attract and grow deposits here in the state of Florida, but also in New York State, to back up that loan growth. And a lot of those loans are commercial and industrial loans. But they had been cautious for a few quarters. This most recent quarter, they sounded a much more upbeat tone. For most of last year and up to the presidential election, Bank United underperformed. And again, as I said, there are a number of reasons for that. But Bank United was actually down from the end of 2015 up until right before the November elections. It was down 15.7%, even including dividends. The large banks were up 5.3%, and the small regional mid-sized banks were up 10%. So that's more than a 20% lag off the BKX, 25% lag off the small banks. And you can see it on the chart here. Bank United is that black line, that sort of orange dotted line, dashed line rather, is the KBW banking index, the large banks. And then that lighter colored dotted line, that would be the regional banks. So you can see before the election, Bank United a big laggard. Again, the reasons for that huge commercial real estate loan book, which has had some regulatory issues, the sort of history of them being a failed bank at one point, and the fact that they sounded a very cautious note on their loan growth last year, which again changed in this most recent call. Since the election, they've really shot up and really outperformed. The BKU, Bank United, is up 32.5% since the presidential election, compared to 29% for big banks and 26% for small banks. So they have outperformed both of those indices since the election. However, despite that, as I mentioned, Bank United is still very cheap. Trades at 1.736 times tangible book value versus about 2.3 times for the KBW regional banking index. So still cheap. We think Bank United can close the valuation gap. Here's the regulatory change on the commercial real estate front that is the key to the investment case of this company. In December 2015, this guy named Thomas Curry, who is the head of the Office of the Comptroller of the Currency, the OCC, announced that commercial real estate loan concentration at regional banks was a risk and would be subject to more regulatory scrutiny, potentially. He hinted at that. The OCC is the regulator for this particular industry. He indicated that a regulatory threshold of 300% of capital, so if commercial real estate loans make up 300% of capital, is sort of the level at which regulators would become concerned about regional banks' exposure to commercial real estate loans. Bank United is at 286% of capital, among the highest in the regional banking business. So that fear was that they would really very soon, if they kept growing their commercial real estate loan book too fast, face increased regulatory scrutiny and associated compliance and regulatory costs. So that was the concern. That was the main reason it underperformed last year. Curry's term expires April 1st, and President Trump is going to nominate a replacement. Some of the names that are being floated, all of the names being floated, are much friendlier to the industry than Thomas Curry. We believe, and the market seems to be reflecting, that the OCC's focus on commercial real estate loans is not going to be as severe as it might have been under a Democratic president, a President Clinton, for example, than it is going to be under President Trump. It's going to be much easier under President Trump. And Bank United seemed to indicate that they have a little more comfort around their commercial real estate business this year as a result of that. On top of that, Bank United has spent a lot of money growing their commercial and industrial loan book, and that's still going to be a big chunk of their $3 billion in loan growth. They indicated that CRE loans are not going to be growing as fast as they have in prior years, which means that other parts of their loan book are going to kind of pick up the slack. So definitely a better regulatory environment for CREs and improvements elsewhere. They do believe that they can get that $3 billion in annualized loan growth this year without crossing the 300% CRE threshold anyway. And of course, that would mean the CRE business is likely to grow slower than in the past. But as I said, that 300% threshold probably won't make as much difference as it would have otherwise under a different administration. And they are, again, seeing a pickup in growth from their other businesses. So we believe the market's prior fascination, if you will, with their commercial real estate portfolio that caused their valuation to be so low is unwarranted. This bank is returning to growth and deserves a valuation, maybe not up to the same level as the rest of the industry, but certainly closer to where the rest of the industry is. We have a buy target of buy under 40 on Bank United. Our ultimate target is 50 to 55 for the stock. So those are our 5 picks, and I'll review them again, so if you missed them, don't worry. Of course, they're in the slide pack that you received in PDF format. What are the biggest risks for the banks? Well, there are several out there. I think probably the biggest in the near term is that the U.S. stock market's extended. This is a chart of the S&P 500, which you can see on Friday, March 10th, closed at 2372. Which is not far off an all-time high, which was set on March 1st of just over 2,400. And one of the things I like to look at simplistically to see whether the market is overextended or not is I look at that yellow line on this chart, and that yellow line is the 200-day moving average. And when the market gets really extended above the 200-day moving average like it is now, I mean, the market's trading at 2372. The 200-day moving average is under 2,200. So that's 170 points, 175 points below the current quote, and almost 200 points, or actually over 200 points below the recent highs. So that's a pretty big pullback, and I would say the market could pull back to the 200-day and still be considered in an uptrend. We saw the market test the 200-day. We see it test the 200-day almost every year, including twice last year. It was under the 200-day early in the year when we had that big sell-off. It had tested the 200-day again in June after Brexit, and again in November right before the presidential election, right before and after the presidential election. So certainly the overall market could pull back. Financials and banks are a big portion of the S&P 500. I can imagine some of these banks getting dragged down with a broader market sell-off, not necessarily predicting it's going to happen imminently, but it is a risk. And I think that's the biggest near-term risk for the banks. However, there are also upside risks for the banks. The last big bull market for the banks was really back in 2003, 2004, and 2005, as the market began to anticipate the Fed rate hiking cycle between 2004 and 2006, and then as the Fed started hiking rates. And as you can see over this period in time, the market, the regional banking index, the KRW banking index, KRB banking index, it rose from a level under 60 all the way up to around 100, which was a total gain of about 70% or 24.7% annualized over this period, which is very solid, beat the market. And it was almost a straight line higher. There was one 9% correction in 2004, and there was another 10% correction or so in basically early 2005. Other than that, it was basically a straight line higher. So there is a risk that instead of pulling back, these banks, though they've had a nice run since the election, may only see a very modest dip off their highs and basically just run straight higher. So I see upside and downside risks, and these are short-term risks. In the long term, though, I think financials are going to be one of the best performing sectors of the S&P 500, and going to see a lot of upside over the next 1 to 2 years, potentially even rivaling this period in time I have here, when banks had about a 25% annualized return. Therefore, I think that we need to use a careful strategy of buying these banks. I chose these 5 banks. They all have unique catalysts. Some of them have little quirks in their business, like Webster's HSA business, Bank United's low valuation due to the CRE, which I think the commercial real estate loans, which are going to have a big regulatory change. Silicon Valley banks, their capital markets subsidiary that invests directly in these small startup companies. There are a lot of catalysts for these names that I've mentioned. They are plays on different parts of the country, and I think it's not a bad idea to buy a little bit of all 5 of these banks rather than picking one of them that you like most. Gives you a little diversification between these different stories. And as I said, I do think they're going to be the top performing market sector over the next couple of years. There probably will be some pullbacks, though in prior cycles, they've often not pulled back much. Extended stock market is the #1 short-term risk. Disappointment with the regulatory momentum is another downside risk. In other words, if it takes longer than expected for the President Trump to make changes to the SIFI designations or moves of that nature because, for example, Congress gets bogged down with tax reform or the Affordable Care Act repeal and replace initiatives, that could cause some disappointment and some pullbacks in the stocks. But faster than expected rate hikes would be a big upside risk. If the Fed starts hiking rates 3 or 4 times instead of 2 or 3 times as the market's been expecting, that would imply a lot more money dropping right to the bottom line, increasing net interest margins, and a lot of upside potential for the banks. They may not give you that pullback at all. Some analysts on a call recently I was listening to describe the current environment as kind of like the financial crisis in reverse. And that makes a ton of sense to me. During the financial crisis, the economy obviously went through a horrible time, the Great Recession. Coming out of the financial crisis, there was this big push towards greater regulation to, prevent something similar from happening again. And those 2 twin headwinds basically caused the banks to underperform for years. Now we're seeing the opposite effect, an accelerating economy, rising interest rates, not lower for longer scenario, but rising interest rate scenarios, helping the banks fundamentally, and lighter regulatory touch, helping the banks on the government side. So it's kind of the financial crisis in reverse. I think could be even bigger for the regional banks than that 2003 to 2006 cycle that I showed you. So we suggest buying some of each of the banks I've mentioned at current prices and using dips as an opportunity to add to your position. So buy a little bit now and buy a little bit more on dips. What do I mean by a dip? Here are our buy recommendations. KeyCorp we have as a buy under 1925. I'm setting up also these dream buy prices. If, because there's a broader market pullback or there's some delay in regulatory momentum or any of the risks I told you on the downside, it's possible KeyCorp could dip down to that $16 to $17 range. I would consider that a dream buy price. That would be a time to really add aggressively to KeyCorp for what I still believe is a long-term target of 24 to 25. Actually, not a long-term target, a 1 to 2 year target. Comerica, we have as buy under 75. Our dream buy price there would be a dip to 60 to 65. One way you can handle these dream buys, and those of you who are subscribers to Energy and Income Advisor have heard us use this term before, you can actually go to your broker and set up what's called a good until canceled, or GTC, limit order. And what that means is it's an order that your broker has on hand to buy a stock at a certain preset price or better. So for example, if you go to your brokerage account right now, you'll see that KeyCorp's trading around 1860 something, and you could set a good until canceled limit order to buy it at, let's say, 17. And if KeyCorp ever dips down to 17, even if you're away from your desk, you're out playing golf or having lunch, or maybe you slept late, who knows, and KeyCorp dips to 17, your broker will automatically execute an order to buy that stock at that price automatically. That's a great way to execute these dream buys. Comerica, buy under 75, dream buy dips 60 to 65. Target there is 90 to 100. Silicon Valley Bank Financial, or SVB Financial, buy under $190 a share. Dream buy on dips to 165 to 170. The target there is 250. Great bank. Webster Financial, buy under 55. Our dream buy there dips to 45 to 50. Target 70 to 75. And Bank United, buy under 40. Dream buy dips 33 to 35. Target is 50 to 55 on that name. So those are a little more specifics about the strategy we use to buy all 5 of our top banking names. So with that, that's the end of my prepared remarks. I would really appreciate it. All of you who are in the beta test for Deep Dive Investing, we really love to know more about what you think about the service, what you think about the beta tests, comments, suggestions, criticisms, constructive criticisms. Please let us know. Our email address is deepdiveinvesting@capitalisttimes.com, or you can give our customer service manager, Sherry, a call toll-free, 1-877-302-0749. She is based in the Eastern Time Zone and works from 9 until 5. The phone line's open if you'd like to call in. So those are the prepared remarks. As I said, one of the biggest criticisms we had of, mostly people liked Roger's presentation a lot, liked the picks, but had trouble reading the charts. So we've tried to make that easier this time around. I tried to increase the size of the charts. And if you couldn't see them on this video, hopefully you followed along with the PDF file, which I also sent you a link to. In addition to that, I attached an appendix as a separate file, and it's basically just a table. And it's a table of 70-some banks that I looked at in researching this presentation tonight. And I've included a number of different fundamentals on that table. And if you printed out a copy of that table, you should be able to read it reasonably well. Numbers are a little small, maybe get a magnifying glass or something, but hopefully you can read it reasonably well if you printed it out or look at it on a big screen. I sorted these banks by assets, so the largest banks are at top and the smallest banks that we're covering are at the bottom. You can see all of the banks I recommended today on that list. And the fundamentals I chose, obviously the symbol, the total assets. The key thing to look at there is whether it's a SIFI bank or not. I've got banks on this list ranging from JP Morgan Chase with 2.5 trillion in assets, all the way down to West America at the bottom with 5.4 billion in assets. So that's very important fundamental. I have the total loans as a percentage of deposits. Basically, if a bank has more loans than deposits, it's going to be tougher for them to grow their loan book because they probably don't have the deposits to support growth in their loan book. A lower ratio of loans to deposits means that they have more room to grow. So generally, you're looking for a lower number there. So for example, you look at a name on the list like some of the names that we recommended on today's call. SVB Financial, their total loans to deposits is only 51%. So you can see they have a lot of upside room. And Comerica, their total loans to deposits is 83%, so they have a lot of room. Comerica routinely, before the financial crisis, had loans in excess of 110, 115% of deposits. So a lot of room to grow their loans without even having to attract more deposits. Next to that, I have the price to tangible book value, a valuation measure I told you about. The average regional bank trades at about 2.3 times book value, so it gives you an idea whether these individual names are more expensive or cheaper than the broader banking industry. The next column, return on tangible equity, a measure of profitability used for banks, the higher the better. Net interest margin, it's basically a measure of profitability of their lending business. I've got that for all the banks. I put the 6-month total return in there, so that would be the return on the stock, including price appreciation plus dividends from a little while before the presidential election. That can give you a pretty good idea. The banks that are up a lot, like if you look at if you look at this list, a name like KeyCorp has risen 50% over the last 6 months. That's because they have a lot of asset sensitivity and are expected to benefit a lot from a easier regulatory environment. And the final column is this commercial and industrial loans as a percentage of the total. In my view, the higher the better here. Commercial industrial loans are almost always fixed floating rate loans that are indexed to LIBOR or the prime rate, and therefore they have a lot of asset sensitivity. And looking down the list, you can see that KeyCorp, 36%, Comerica, 55% of their loans are C&Is. SVB Financial, 48% basically. So a lot of the banks we recommended have high C&I loans. Of course, these are not the only 5 banks we're ever going to look at. I am evaluating a lot of other banks on this list as potential longs, or maybe even some potential short recommendations out there as hedges. I may have more recommendations in future updates. Just to give you a couple of names to keep an eye on. One of our favorite big bank right now is Citigroup, which is on this table. And if you refer to your table, it's the 4th largest bank ranked by assets on the table. So it's 4 rows down. What I really like about them is they're the cheapest of the big banks. They trade at a discount to tangible book value. They also have what's called a lot of dead weight capital. And what that means is that under the stress tests, they have a lot of capital that disappears in the stress tests, which means the Fed has been reluctant to allow them to increase their dividends and or buy back more stock. Under an easier regulatory environment, though, where the CCAR test or the stress tests are less stringent, so this doesn't require any congressional work at all. The federal regulator, as I mentioned earlier on, Daniel Tarullo is the current head banking regulator at the Fed. He's stepping down in April, and the new appointment from Donald Trump will help design the stress test for next year. So a bank like Citigroup might have an easier time passing the stress test to the point that it's able to return more capital to shareholders. So that's a big upside for Citigroup. Scrolling on down the list, First Republic Bank, another California bank. Really what stands out about them is they have one of the most affluent base of depositors in the entire country. And I think it tends to be undervalued because they don't have a lot of commercial and industrial loans. As you can see on this table, it's only about 8.6% of their loans. And they have a lot of residential mortgages, which aren't seen as a particularly asset-sensitive business. As I said, they're typically fixed rate, and they only reprice when the person refinances the loan, which typically only happens when interest rate falls, or they move and have to get another loan. But in FRC's case, they're in, as I said, Northern California. That area has a lot of turnover in the housing market. So their average residential mortgage loans only last a few years anyway. So they do have a lot more exposure to upside in interest rates than is popularly imagined. So very interesting name there. Zions Bank Corporation, symbol there, ZION, another one I'm very interested in. And the reason I didn't recommend First Republic, by the way, is we already had a California bank, and I like SVB a little more, but definitely one I have on my radar screen. Zions Bank Corporation is based in Salt Lake City, Utah. Total assets there, $63 billion, so they're a little over the SIFI designation. Could benefit from a change there. A lot of floating rate exposure, but also a lot of commercial real estate exposure. Therefore, they'll benefit from changes at the OCC that I talked about referencing Bank United. Also, they have a lot of deadweight assets like Citigroup in the stress tests, and I think an easier CCAR test, easier stress test would allow them to return more capital to shareholders. screens among the best in the coverage universe that I'm aware of. East West Bank Corp. This company is based in California as well. They were actually set up to serve the Asian community in California. They have branch offices in China, and they do a lot of trade-related loans. So there is some concern about the potential for a trade war between the United States and China to impact their business. But management's been really upbeat there. There's a lot of growth in that community in California in lending terms. They have a lot of loans to small businesses, another very interesting asset-sensitive bank. Looking a little further down the list, Cullen Frost Bankers, CFR, Texas bank, the highest exposure in my coverage universe to energy loans. So one to definitely watch. If we get a big pullback in oil, this stock I think could sell off quite a lot. In fact, it might even be a short trade on the short side for some of you in the near term, something we're looking at in Pig versus Bear actually. But if there's a sell-off in energy and you want to play a rebound in credit quality or recovery in commodity prices, CFR would be an interesting trade to look at. Definitely one to keep on the radar screen. First Horizon National, a Memphis, Tennessee-based bank, solid business bank. A lot of asset sensitivity. Only knock for them is they have a bond trading business, which tends to underperform during rising interest rate environments. Really solid bank, solid depositors in a part of the country, very little competition whatsoever for deposits. So I think it's an excellent bank. I think it's undervalued at 2.15 times tangible book value. Only thing that has me giving it a pause, hitting pause on that one, is that bond trading business, which probably won't benefit from rising interest rates. Looking at some of the smaller names, Bank of Hawaii is interesting. I'm not ready to recommend it right now, but Hawaii is an interesting market. It's one of the only states where none of the major banks, the JP Morgan Chases, Bank of America, Wells Fargo, and Citigroup, they don't really exist there. Almost all the deposits are held by local banks like Bank of Hawaii. So it's a really local, a market where there's not a lot of competition at all for deposits. Kind of an interesting play. The loan growth is decent there. I'm not real excited about it right now, but it is on my radar screen. Here's another one, Great Western Bancorp, symbol GWB, and I'm just moving down the list. This bank only has $11.5 billion in assets. They're based in South Dakota, Sioux City, South Dakota. Heavily into lending to the agricultural market. 25% of their loans are to the agricultural business, both grains, corn farmers, etc., as well as protein farmers, ranchers. A lot of concern about credit quality there because farm incomes are down so much and crop prices are down. I think that's like way overblown because the fact is that Great Western has a long history of running this bank through. It used to be actually an arm of National Bank of Australia, a big Australian bank, but they're now independent. They were managing this bank. The managers there were managing this bank back in the 80s when crop prices went through another bear market. And they only lend to farmers up to the amount that's insured by federal crop insurance. So these really are low-risk loans. I don't think it's going to see anywhere near the deterioration in credit quality the market expects. Other than that, what a solid bank. Great return metrics, good asset sensitivity, definitely one to keep an eye on, especially if crop prices start to recover. Also one I'm looking at over the next couple of quarters. Maybe if they don't show much of a decline in their credit quality in that agricultural business, I think the market might gain a little bit more confidence in them and reprice the stock to the upside. Another name, FCB Financial Holdings. It's a $9.1 billion asset bank. Florida Community Bank they own here based in South Florida. A real small local lender, very fast growing. They have a fair amount of asset sensitivity. Just a very fast expanding bank. Kind of a diamond in the rough, if you will. Most brokers don't even cover the stock because it's so small. Very fast growing. I like the way management's being very conservative about lending to some parts of Florida that have residential or commercial real estate, if not bubbles, just excess growth. They're a local bank, so they really know their customers. They really know who they're lending to, and that's a humongous advantage. Obviously, could be an acquisition target. They're a small-sized bank in Florida. If the acquisition market heats up again, that would be one bank I could definitely see getting acquired. FCB Financial Holdings, just another name that I'm looking at. So even that's not totally all of the names that are on my watch list, but that just gives you a little rundown of all the stocks that I went through to create this presentation. You have the appendix with some of the key financial metrics. In future issues of Deep Dive Investing, Roger and I will be updating our prior picks. I didn't update Roger's picks in terms of returns and whatnot this time because he just made them last week. But in future, you will have that, and you will have more updates. Again, thank you very much for listening today, and send us your comments, deepdiveinvesting@capitalisttimes.com.